economic analysis, market updates, and where to find opportunities now. Strengthen your investment strategy on the exchange. CNBC.
Before I go out, for me, the more relaxed I can be, the better. As soon as I try and create that situation where I'm tense, I'm like, okay, something big's about to happen, I need to do this. Like, that's when I just don't perform to the level that I need to. And maybe that works differently for other people, and other people, you know, they go and have a kick with a football, or they go do some boxing and they get hyped up. You see their warm-ups, they're getting sweaty, and I'm just lying there having a little nap.
I can't believe that landed. What, you can have a nap before?
I'll have a nap. Yeah, it's like the lower my heart rate, the better I'm going to do. Because when I get in the car, you know, as soon as the helmet goes on, you're in your own world. It's me, it's my car, everything's disappeared, and it's just you have to focus on what's ahead of you. I'm still nervous, I'm still crazy nervous before races. I'm an overthinker, so I think of a lot of stuff. So the more I can almost calm myself down and just think, okay, all I got to focus on is the start. Then after the start, the rest will happen.
I watch Fast Money every day.
Every person that watches our show can get something out of what markets have done that day and some investment ideas, and you don't have to be a professional.
I learn so much from them, and I often act on their suggestions.
You have to be nimble, but you don't want to sort of be distracted by whatever the thing of the moment is.
Being here on the set with the bright light shining, and it's a different experience.
This event was so important, gave us access to our fan base, gave them access to us, and let us meet in an environment that's a lot of fun and something a lot of people will never get an opportunity to do.
I love these, Tim. This is such good timing. Also, you're having another live event.
Yeah, thanks, Sarah. Well, it's probably a great time to do it. Honestly, what we were doing back in the end of February and what we're going to do in June, it's huddling up with our audience and really talking about markets, testing out theories. I mean, it's really a chance to have those conversations that are the ones that probably require a little bit of time. It's a time to everyone to get to know each other a little bit. But it's really, I mean, it's tons of fun. We had a great time. But I think in difficult markets, it's really a chance to kind of reaffirm a lot of views and talk about ideas, and I think that's probably what's going to be really
your ideas and their questions. I feel like that's also instructive.
It's a good. Well, who knows? Maybe Dan's ideas, maybe Guy's ideas. I mean, I think part of it.
I got booed.
Well, it's a combination of bringing a lot of ideas to the table, and I think that's what that experience was like, and I think people felt that.
No one gets booed here. Meanwhile, after spending a chunk of the day firmly in the green, bank stocks getting caught up in the sell-off like everyone else late in the day. Only J.P. Morgan hung on to gains. But with earnings season coming at the end of the week, how do you play the banks from here, Carter?
You know, I think I would default, and he said it exactly, it's not going to matter. I mean, just what you said, what Delta's
earnings
about
aren't going to matter.
Right, the earning. I mean, obviously, price action. The outlooks aren't going to matter because they don't have an outlook that was good, and now they have to suspend it based on all the things that have come along. So that you can look at the options market and see what the implied moves are. For instance, Delta's got an implied move of 10%, and make your bets. But it is, in this particular moment, it is all macro, and it really isn't going to matter what they say, and they don't have any ability to guide forward either.
I guess the question is, so Tim, this was one of the most popular trades going into the year.
Sure was.
Everyone was all excited
Animal
about
spirits, right?
pro-growth policies from the administration, animal spirits, deal-making, deregulation. Does all of that get thrown out the window?
Well, I'm going to sound a little more interested in these earnings, and I understand the context that both Carter and Julian put it into. There's no question. But I really, if I want to hear from anybody, I want to hear from banks. I want to understand, first of all, the trends that we were already seeing on some of the macro. I understand there's a pre-tariff and there's a post-tariff, but I want to get some sense also on credit trends. I want to get some sense really on
credit spreads have widened.
Where they absolutely have. Where I think they're also seeing volatility in the capital markets business. So I think it's very important. I think it's about time we actually get some real data points. I do think at some point markets become a distraction to really understanding fundamentals about companies. So I welcome the earnings season. I think we need some of that right now.
Yeah. Well, when we come back, a potential safe haven from the market volatility. Why our next guest says private credit could provide shelter for your portfolio. Details when Fast Money returns.
The greatest thing about Squawk Box is we get to talk to some of the brightest, some of the smartest, some of the most important people on a daily basis.
Everything we ever create, it's so a person can do something they couldn't do before.
It's more entertaining than any other morning show, but you actually might get some useful information.
Generative AI has the chance to transform every customer experience.
For me, Squawk Box is breakfast with the most interesting people in the world.
You guys all have an amazing heart, okay?
Squawk Box, weeknights.
We're moving from the autopilot era of AI to co-pilot era of AI.
We are just at the dawn of the robotics age.
The more experience you give it, the more capability this AI model can achieve.
Hopefully improves productivity, and it doesn't displace more jobs than it creates.
How to maintain our humanity if we live more and more digital lives.
The new era of tech on CNBC.
I took my first journalism class in high school. It felt like a superpower. I find it really meaningful to reach new audiences, women, people of color, younger demographics. A lot of traditional financial advice might not take into consideration that people have debt or that rent is so expensive. To me, ambition means taking on new opportunities that take you out of your comfort zone, but help you learn and grow.
Welcome back to Fast Money. Markets failing to hold on to that early relief rally this morning, dropping steadily throughout the day and then closing near the lows of the session. The Dow down more than 300 points. NASDAQ down 2%. It was up more than 4.5% this morning. The S&P closing below 5,000 for the first time in a year. It's also clocked its worst four-day loss since the peak of the financial crisis in 2008. But our next guest says there is one space insulated from tariffs and market volatility, which is private credit. Churchill Asset Management CEO and President Ken Kencel joins us on set. His firm was the most active U.S. buyout lender in 2024, according to PitchBook. Welcome, Ken. This notion of a safe haven is important because gold's not getting it done, treasuries, dollar, none of that is providing safety. Why is the private credit market so safe right now?
Well, look, I think obviously the events of last week have created a tremendous amount of uncertainty in the markets. And I think we're all in a bit of a wait and see mode in terms of how things play out. But I think private credit has always been a more stable and certainly diversified investment class. And look, I think from our perspective, we were in the midst of a record quarter in the first quarter. And I'd say, at least for now, things continue to move forward.
But it's never really been through a recession or a crisis or a credit event. Will that test?
Well, COVID was. If you look at how we.
But didn't it really boom? Like to a much larger degree after COVID?
It certainly has.
Yeah. So are there cracks?
Not that we're seeing yet, right? So I would say that obviously, and you wouldn't expect to see them at such an early point. But I would say overall, I think a lot depends on the timing of the dynamics that are playing out in terms of the renegotiation over tariffs, how long that takes, how long the market is living with the uncertainty of the current environment. But I would say as a general matter, you could very easily see the public markets, certainly the liquid credit markets, go kind of offline for a period of time. We did see that during COVID. And I think the private markets are there to be able to fill that void. So we have a tremendous amount of dry powder. Most of our counterparts with significant capital are there to provide that liquidity. And in periods of market dislocation, our markets tend to do very well. Spreads tend to widen. Covenants and structures tend to get better. Leverage tends to be lower as a general matter in the private markets. And I would say, moreover, if you look at our private credit focus, and we're fairly typical of private credit, we focus on companies that are primarily U.S.-based. I'll give you an example. 85% of the revenues within our portfolio today, we have about 600 U.S. companies in our portfolio. Underlying 85% are U.S.-based revenue, so less exposure to non-U.S. markets, therefore less exposure to tariffs. And I would say as a general matter, we tend to focus on more service businesses, which are, overall more insulated from economic downturn and volatility.
But Ken, first of all, it's been the golden age of private credit, and so congrats on that. And I think it probably will continue as an asset class. But if I'm cynical, I might say there's been such a flood of money chasing into this asset class, in some cases by investors that aren't really experienced, but I bet your investors are probably more institutional. But
they are.
One would say that there's a lot of money chasing, companies and maybe standards in terms of lending. And when you run into the type of pullback that we could see in a growth shock, it could expose lending standards, and where there's been this flood to put money to work and bring in money's coming in one door, we got to get out the other door. Talk about that and push back against it.
Yeah, no, Tim, I think that's a fair point. And I would tell you that there certainly have been new managers, coming to the table. But I would say overall, what we've seen over the last year or two has really been a bifurcation in the market. The larger, more scaled managers that can literally provide $400, $500, $600 million, $700 million, billion-dollar solutions, those managers with significant dry powder, with large institutional investor bases, with relationships to drive deal flow. For example, we specialize in private equity-owned companies. Those large-scale managers have generally been raising more capital. They've been taking share relative to the smaller players. So, for example, if you look at our portfolio today, if you look at our overall credit quality, the underlying default rates and non-accrual rates, very good. Today, our portfolio, less than 0.1% non-accruals across the portfolio. So I would say for managers that focus on higher quality, market-leading businesses like ourselves, I think we feel pretty good about credit quality to date. And certainly up through the first quarter, we were feeling very good about deal activity as well. So, I think it's a good time. I don't know if it's a golden age or not. I've said that before, but certainly we see the current environment is still very conducive to what we do. And certainly providing liquidity if we do get a pullback in the public markets.
All right.
And we've seen that before.
Good to hear, and certainly one option for investors, I guess. Thank you very much, Ken. Appreciate it.
Thanks, Sarah.
From Churchill. Coming up, energy under pressure, hardest hit sector this month, in fact, as tariffs take hold. Will the group continue to lead the market lower? We're going to debate that when Fast Money comes right back.
Be
First on world markets, first to the global business conversation. Get a jump on the investing day every day with Frank Holland. Success starts early. Worldwide Exchange. CNBC.
Ambition to me is about doing better. In my 25 years at CNBC, the one thing that resonated with me was that ambition has to go beyond oneself. It's about creating that platform, laying out the foundation, rolling out the runway where others can succeed. Ambition is only successful when it benefits communities, the next generation. It creates jobs and impacts livelihoods for the better.
Tiny homes.
Welcome to my tiny house in Atlanta, Georgia.
One woman makes big money with a very little house.
Pretty spacious, honestly.
Plus the Big Apple's version of living little.
My 95 square foot New York City apartment.
And downsizing to unlock a better life by the beach.
No regrets about moving into a tiny house. There's no room for excess or unnecessary objects.
That's all next on Unlocked.
Welcome back to Fast Money. News alert here on Peabody Energy. The stock is actually surging right now, more than 23% after reports the utility is reviewing options in its nearly $4 billion acquisition of Anglo American. Rare bright spot here after hours for stocks. Meanwhile, energy stocks in general have been under pressure as WTI crude settles at 4-year lows. It's the worst performing S&P sector so far in April, down almost 18% during that time. Occidental, Devon Energy, APA, Diamondback among the names getting hit the hardest in today's session. So, Carter, what do the charts tell you?
Yeah, let's look at a few. But the first thing is obviously year to date, energy is down a lot less than the market, and so that's a positive. But is it even a sector, or does it matter? Just look at some of the stats. We know it's a sector, but it's the entire thing is 3.37% of the S&P, and two stocks, Exxon and Chevron, are 40% of the sector. So it's a sector, but two stocks are 40% of the whole thing. It's only 3%. A lot of people employed, very important area of the economy, but as it relates to the stock market, not that important. Let's look at, though, some charts of the XLE. And this is what's informative. Of course, it was the worst performing sector during COVID because no planes are moving, no cars moving. It was the single best performing, as seen here, in the rebound from COVID, going up 300% versus 200 for the S&P. And then for the last 3 years, dead flat, where the market's gone up. So that's an absolute chart. The better way to depict this is a relative chart or a ratio chart, and this is really the story. So it's the volatility that's so shocking. You plunge and underperform into COVID. You are the best performer out of COVID, and then obviously one of the worst performers over the past 2-3 years. The issue is it cheap? Is there some sort of safety here? Final chart, it shows how energy was, of course, the worst performer, the dot-com. That was its relative lows. And yet it was the best performer during the financial crisis because it was safe.
So how do you know when to buy it?
Well, that's exactly right. I think it's time to take an energy stake, that this is so unloved. It's so not important in the S&P. And I would do it through either Exxon or Chevron or, frankly, just do the XLE.
Okay. Carter, thank you. When we come back, Karen Feinerman joins us from the West Coast to lay out how she's navigating all this market volatility and why she is still staying long. More Fast in 2.
So ambition for me is get yourself educated at school and also in life. Make money, but also try and do some good. Do what makes you happy. Do whatever you want to do. Be successful, but also recognize it's really important how you get there. It's not so much the goal or the target that matters, it's the process. I think that really is going to end up defining you as a person at the end of the day.
Good money.
Everything seemed legit until it wasn't.
Good times.
The lavish lifestyle, the houses that they're used to.
Is never enough.
Someone who has a goofy social media presence could be laundering $4.5 billion worth of Bitcoin.
Fame, fortune, and fraud.
His stories were so good, they've all fell for them.
I believe in getting justice.
American Greed on CNBC.
Are you drowning in debt? Stressed over savings? CNBC Make It is here to help. Start your journey to financial wellness today with our new online course. Our experts will teach you about money psychology, saving for retirement, and increasing your investing IQ.
Achieving financial wellness is freeing, it's empowering.
Your healthy relationship with money starts here. Register right now at cnbcmakeit.com/financial wellness.
You're French, the son of two physicians, grew up in a family where you're focused on medicine and life sciences. How would you describe your leadership and your management style?
I'm very collaborative. I don't like consensus, which was something we changed.
You don't
in
like
the company.
consensus?
No, because I think that consensus is slow first, but also sometimes impossible to reach when you have a tough decision to make. So often everybody agrees, but if there is no consensus, it's not a reason for not making a decision. So very collaborative. I try to have a lot of proximity with people. I am very approachable. I want to be very inclusive. I empower a lot the Takeda executive team. So again, I think creating a culture of performance, but respect and inclusion and collaborative.
Welcome back to Fast Money. The Mag 7 hit especially hard in the recent sell-off. The group now down more than 30% from that 52-week high. Fast Money trader Karen Feinerman is in Los Angeles today at CNBC's Changemakers Summit. We'll get to that in a minute. But first, Karen, good to see you. How are you handling all this market turmoil? Did you do anything today?
I think medicated might be the best answer. No, I'm always long, and this is the kind of market that's challenging, of course, for that kind of strategy. But I really look at the VIX, and when I see the VIX spike, I mean, the movement in the VIX today, as you all know, I don't know if you talked about it earlier in the show, of course, was extraordinary. So when the VIX gets this high, I'm going to look to cover some hedges, which gets me longer. So that's what I'm doing. I'm kind of, I want to make sure I own things with great balance sheets. As I said, I am heavy Mag 7, so Meta is a big position, Amazon, now second biggest position. And that's where I feel comfortable staying. It is not my strategy to try to time the market. I have no ability to do that, and I think it's almost impossible to do. So I've got to stick with things that I'm comfortable owning, balance sheets that are great, businesses that have moats. Clearly, everything's going to be affected if we don't resolve this tariff situation soon.
One thing I was really looking forward to hearing from you about was retail, because that is also one of your specialties. And, it sort of doesn't matter if you're in a good retail story or a bad retail story right now. They're just all getting thrown out because of the tariff risk and exposure. Have you made any moves there?
I haven't made moves. I mean, there's some things that I think are cheap that I would like to. But I feel like I need a little bit of clarity. My biggest retail position is Walmart, which, of course, is down. It's down less than some others because of their size. And Amazon, obviously, is a big sort of retail as well. But I haven't added to anything new. Normally, I would have. But I'm just so uncertain, and so I have to keep some powder dry for when we have some clarity.
All right, as we mentioned, you're in LA for the second annual Changemaker Summit, recognizing the 50 women who are transforming their industries. What can you tell us? How's it been so far?
It's been fascinating so far. I mean, we're women from so many different types of businesses. And we just had the mayor of Phoenix, Kathy Gallego, who is fantastic. Nafisa Collier is here, the extraordinary basketball player. So, I mean, so many different women. I always get inspired in hearing other women's stories of how did they navigate, how did they get to where they are. And Julia, of course, does a really fantastic job.
Yeah, our shout out to Julia Borsten. Karen, thank you very much. It's good to see you. Have fun at the rest of the conference. Not too much medication. Up next, your final trades.
Crucial market coverage, actionable insights, can't miss reporting that'll impact the tape and your money now. Be here when the opening bell rings. Squawk on the street. CNBC.
Tiny homes.
Welcome to my tiny house in Atlanta, Georgia.
One woman makes big money with a very little house.
Pretty spacious, honestly.
Plus the Big Apple's version of living little.
My 95 square foot New York City apartment.
And downsizing to unlock a better life by the beach.
No regrets about moving into a tiny house. There's no room for excess or unnecessary objects.
That's all next on Unlocked.
You want people to trust their money.
This is the market that we're operating in. They need to drive their plans forward.
We need to pursue new business opportunities.
You're always better off having a fortress balance sheet.
Prudent fiscal policy can contain debt.
You're going to take less risk to get to your target now more than ever before.
Making sense of the global economy. CNBC.
You know, for me, ambition and passion go together. One fuels the other. You love something, you want to get better at it. You want to learn more about it. And I think CNBC allows our viewers to fulfill their passions. There's no doubt that the people who watch us care. I am very much focused on trying to land interviews where there is something at stake and asking them fair but tough questions in which their answers are important. I could not imagine covering anything else.
For the final trades, let's go around the horn. Julie.
UL Solutions has held up pretty well. I think it's worth looking at.
Tim.
Sarah, great having you here.
Thank you.
Go Gators. Exxon.
Gators?
Yeah, they won last night. That's right.
Dan.
Yeah, TJX. The best acting stock in the entire market.
Carter.
A two-for. Let's go with Chevron as well. She got Exxon and Chevron.
Okay, there you go.
Well, good morning across Asia and welcome to CNBC's new show, U.S. Markets Edition. I am Brian Sullivan in the United States, and we are glad that you are starting your day with us. Before we hit all the newsmaker and top conversations you may have missed with us on Tuesday, let's talk about another wild day on Wall Street, because once again, there were massive swings throughout the day. We woke up this morning here in the States with some relief. Markets, futures, they were higher. In fact, at the open, markets popped as much as 4% on some indexes across the board. But then the sellers came in midday, and with about 2 hours to go in the market, we saw a huge move down. In fact, we ended lower across the board. I'm going to show you the charts. But again, these do not represent what actually occurred. S&P down 1.6%, NASDAQ down 2%, and these are Russell 2000s, mostly domestic U.S. companies, down nearly 3%. But as we noted, these indexes all up 3 and 4% earlier in the session. In fact, one of the first 4% swings intraday we have seen in years for the S&P 500. What about the big cap tech stocks, the ones that have been moving the market? Well, they may be moving the market, but they may be moving it lower. Apple down another 5%. And I say another because Apple is down 4 days in a row. It's lost 20% in 4 days, and is now in the worst stretch since the financial crisis of 2008, Amazon, Microsoft, and the CNBC Magnificent 7 Index, maybe we need a new name for that, also all down. Currencies, we know, are hugely important across the world, particularly in Asia. Dollar index, not so much of a move, but we did see one for crypto, in particular Bitcoin. It continues to fall with the stock market. Bitcoin at 76,650, down another 2%. Bitcoin down about 10% in just 1 week. So all in all, the charts tell the story. Another very rough day on Wall Street and for investors. And as I noted, here's a pretty telling stat from the CNBC team. This is the first time since COVID began 5 years ago that the S&P 500 wiped out 4% intra-session. Wow. We know a lot of this is carrying over into the Asian markets as well. The global fears, they are spreading. So now that we've hit the numbers, let's jump into some of the biggest interviews and conversations happening across CNBC in the U.S. today. And we begin with the state of negotiation. U.S. Treasury Secretary Scott Bessent speaking with us about talks with Japan and China as trade tariff problems simply escalate.
The president had a very good call yesterday with the Japanese Prime Minister that led to these negotiations. And look, the Japanese are military partners, they're economic partners. We have a substantial imbalance with them, and I'm sure that they are as anxious as we are to get this remedied. I think everything's on the table. So their tariffs. The academic literature shows that it's actually the non-tariff barriers, which are both harder to quantify and harder to, they're more insidious because they're hidden, they're obfuscated. So tariffs, non-tariff barriers, currency manipulation, and then subsidies to both labor and industry. So everything's on the table, Becky. I think it was a big mistake, this Chinese escalation, because they're playing with a pair of twos. We are the deficit country. So what do we lose by the Chinese raising tariffs on us? We export 1/5 to them of what they export to us. So that is a losing hand for them.
Now, Treasury Secretary Bessent also said the president is going to be personally involved in negotiations. We shall see if that actually helps the markets going forward. In the end, it did not on Tuesday. And that is not all that is going on. There's also massive infighting happening between the White House and Elon Musk. And it kind of all started with this. Here's trade advisor Peter Navarro on CNBC.
When it comes to tariffs and trade, we all understand in the White House, and the American people understand, that Elon's a car manufacturer. But he's not a car manufacturer, he's a car assembler. And he wants the cheap foreign parts, and we understand that. But we want him home. We want him home for our national security and economic security, and everything's good with Elon. It's no problem.
Calling him a car assembler did not sit well with Musk. In response to that video, Musk said, quote, Navarro is truly a moron, and what he says here is demonstrably false. He then added that Tesla has the most American-made cars. Navarro is dumber than a sack of bricks. Musk later piled on again, fake apologizing to sacks of bricks. All right, you could chuckle. It's ugly stuff. But it does impact trade policy. And we asked former White House Chief of Staff under President Trump's first term, Mick Mulvaney, and former Democratic Senator Heidi Heitkamp about it Tuesday afternoon on CNBC.
This is more than just about an squabble inside the White House. This is important, right? Why is that? Yeah, Peter is really tough to work with. There's no question about that. One of the things that makes him so difficult to work with is that he pretends to speak for the president when he does not. All right, Peter was notorious back in Trump 1.0 to walk out of a meeting when everybody would sort of assume we've got sort of a consensus about something, and he would go on TV and say the exact opposite. That has a tremendous demoralizing effect on the White House, and it does tend to mislead markets. For example, when people think that Peter Navarro is, when he says we all know in the White House, that's not the White House speaking. That's Peter Navarro. And what I think is important for people to realize is that
does Peter Navarro, who went to prison for the president, does he need to be fired?
I would have fired him a long time. I would have fired him when he got caught making up his academic sources for his papers with his Ron Vara imaginary friend. But, I mean, that was Donald Trump's call then. It's Donald Trump's call now. I think folks watching this show are caring more about what is the policy of the White House? What is the policy on tariffs? What does the future hold on this? And Peter Navarro is not a reliable source for information about that.
Senator,
yes.
If the question is, to whom should the business community be taking its cues, right? To whom should the market be taking its cues? Is it Bessent? Is it everybody? Yeah. Is it the president and only the president?
Well, all of this, there's an audience of one, and that's the president of the United States. Peter Navarro is saying what the president believes, which is tariffs are good. Elon Musk is not. And so you got to balance that. But I would listen to what the president says. As Mick said, a lot of people think that they speak for the president. They don't. And this president is going to stay the course. And all of the confusion last week and this week about whether he's negotiating or not negotiating, whether he's going to raise money with tariffs or whether this is just a ploy. All of that, it seems to me, is sending a lot of mixed signals, but those mixed signals are actually coming out of the president. And so from a political standpoint, Democrats are just sitting back and watching the chaos.
White House Chief of Staff Mick Mulvaney with former Senator Heidi Heitkamp. Legendary investor Ray Dalio also commenting on President Trump's tariff policies, global production, and getting U.S. debt and spending levels under control.
I agree with the problem, okay? I am very concerned about the solution, okay? The practicality of the solution. In other words, I think that this is going to create not only the problem, the capital markets problem that I'm talking about related to prices going up, costs going up, prices, revenue going down, and capital problem. But I also think that this is going to create great sand in the gears of production worldwide. At the same time, I do agree that this interdependency, this issue of productivity in the world in which we have to be competitive and productive, and we're not competitive in producing things, is a longer-term problem, not an easy one. And I do expect that it is going to have political consequences. This is the nature of the cycle. It is coming also at the same time as we have a budget issue. Now, the budget issue is a comparably important issue. So as we look ahead in the months ahead, we have to get the budget deficit down to 3% of GDP. I worry about that at the same time as this is happening. These are not easy problems to solve, I'm concerned, because the bigger problems exist. The debt exists. You can't get around the debt. The overspending exists. You still have that. You still have that competitiveness issue. These have repeated throughout history. We're in a period that's very much like the 1930s.
Ray, I think if China
didn't exist, I'm not even sure we'd be in this place in terms of public sentiment for tariffs. Not very many people disagree that we need to do something, even with tariffs, to try to deal with China. And I know in the past you've talked about China, and there's been times where I thought you were kind of I don't know, not pro-China, but less hawkish towards China than a lot of people that we have on. But this is going to be the most, just look at the rhetoric in the last couple of days. This might be the most intractable part of this whole tariff, whatever this is that we're in right now, the age of the tariffs. But I don't know how you finally resolve things with China. I don't see an end.
I'm not ideological. I'm like a mechanic. And so when we're talking about this, I'm saying that China, now I'm agreeing with you. China now manufactures more than the United States, Germany, and Japan combined. It's a dominant competitive manufacturer in the world. And we have lost manufacturing. And we are then creating, we're the biggest consumers in the world. And so through this, we're financing that consumption with a lot of debt. So we have a very, very difficult situation.
Hey, Ray, what does this mean for, let's say, our purchases of our treasuries by foreign investors in the near term?
The supply, foreign investors as a group have large exposures in their portfolios, outsized exposures to debt in general, and to have too much in terms of U.S. debt. The quantity that we have to sell them, which is about 6.5% of GDP, is an amount that they don't want to buy, partially because they have too much, partially because also now this is a risky world for various reasons. Worries about sanctions. This all happened in the 30s, you know, the conflict between Japan and the United States and freezing assets, sanctions and such things enter into it. So there's a supply-demand imbalance, the quantity that exists of debt and the quantity that has to be sold of debt.
The billionaire Dalio, also known for saying that cash is trash, and he repeated that mantra by saying it's the worst investment you could make over time, although, let's be clear, cash doesn't look that bad right now. Well, full tariffs on China take effect in just a couple of hours, and the question is, does this make things worse, or is this mostly priced in? Here's Wells Fargo's international economist Brendan McKenna on the global tariff fallout.
I think we're starting to see some headlines as it relates to Japan and maybe South Korea, also maybe Indonesia, that maybe are a little bit more willing to come to the table and negotiate and try to bring some of those tariff rates down. But to your earlier question and your earlier point, you know, I definitely think that there are some tariffs here that are going to be permanent in nature. And I think the more contentious, more hostile trade policy is certainly going to be a cornerstone of the Trump administration for at least the next 4 years or so.
Right. What do you think the real fallout is, though? I mean, if you had to say the most noteworthy response you've seen from the international economies affected, from Vietnam to you name it, to Taiwan, I mean, all the rest of them to Europe, what do you think it is so far?
I think it's really the response from China. You know, I think the initial response to Trump administration tariffs on China was that China was going to take a more gradual approach and they weren't going to be overly retaliatory. But that narrative has really flipped in the last, call it a couple of days or so. They responded with a 34% tariff. Then you see headlines overnight that they're not going to back down from a tariff fight. And I certainly think that they're willing to dig in for the long haul. So I certainly think the most kind of interesting response has been from the China side, and then maybe some of the other closely knit China economies in Southeast Asia as well.
Now, McKenna went on to say that if the United States is not a viable marketplace for China, the EU, Australia, or other parts of Southeast Asia could be subject to deflationary pressures, which could weigh on global growth and cause more turbulence in financial markets. Big story. All right, up next. what a Nobel laureate thinks about all this and Europe's role in the tariff turmoil. That's next.
Across global markets, data underpins every decision that is taken. At ICE, we provide quality data and analytics across multiple asset classes, from fixed income, energy, commodities, and equities, to areas like climate risk and the entire life cycle of a mortgage. To help inform trading decisions, our pricing and reference data covers millions of instruments. In fixed income, our data can help reimagine your workflow. In energy, our oil and natural gas data is used by global traders, while our energy transition data helps navigate the shift to a low-carbon economy. In mortgages, our data covers the life of a loan, from origination to secondary markets. We can meet your data needs wherever you are. Whether it's pre-trade analytics, pricing, or post-trade reporting, our data can offer a foundation for sound decision-making, helping market participants to manage risk and spot opportunity.
Real money, real debate, real-time moves. Scott Wapner and the Halftime Committee break down key trades. Get an edge on the market's next move. Halftime Report, live from the New York Stock Exchange. CNBC.
The Power Plays are here, breaking down the markets with updates and deep dives. What's moving now and what's next for your money. Sarah Eisen, Carl Quintanilla, Money Movers. Weekdays, CNBC.
And welcome back to U.S. Markets Edition. The European Union preparing to respond to the Trump administration's tariffs. Former IMF chief economist and Nobel laureate for economic science, Simon Johnson, explained how the EU will approach negotiations and what it can all mean to you.
Well, the EU is obviously thinking pretty long and hard about this, Andrew. They are not going to roll over. I don't think they're going to, want to seem meek or entirely compliant. They have offered a 0-for-0 deal on industrial tariffs, kind of a nice, strong offer. I think actually they put that on the table before Liberation Day, and I think it's probably still on the table. And they could go as far as their so-called anti-coercion instrument, which will allow them to take countermeasures against U.S. exports of services. That would be pretty dramatic. But I think there's some countries within the bloc, including Ireland, for example, that are going to want them to tread carefully. So they'll try to negotiate. Just as Secretary Bessent said on your show a little bit earlier, negotiations are open. It takes a long time. It's messy. But I think the EU will try to be constructive and positive about this.
Simon, the question is, to the extent that we're talking about that tax, I mean, part of this is the tariff piece, and then part of it is going to be VAT and all sorts of other component parts to this, and each country is doing a different thing. And so I'm trying to understand how they would be able to do it as a bloc.
Well, the EU can do a lot of things as a bloc. That's not a problem, Andrew. It's slow and tedious and a little bit boring from an American perspective, sure, but that they can do. The value-added tax is a massive red herring, or worse than a red herring. Value-added tax is not discriminatory against imports. It's nothing to do with trade.
Simon, I don't disagree with you. I'm just suggesting if you speak to the Treasury Secretary or you speak to Peter Navarro, they would argue to you that the VAT is a component part of their problem with what's happening inside the EU.
Well, Peter Navarro definitely says that. And I listened very carefully to what the Treasury Secretary was saying on your show a little while ago, and he was not saying that, Andrew. So that the administration, once again, needs to get on the same page. And the VAT is going to be a very important sticking issue with the EU. They're not going to get the EU to roll back or withdraw VAT. It's a massive, very important source of revenue. It's how they structure their entire public finances. That's a non-starter. And so the question, Andrew, is, are we really in a good faith negotiation? 0-for-0 would be a pretty good deal, actually. And there's other things you could get from the Europeans, other things we could give them. Or are the negotiations entirely fictitious and it's just going to be a shouting match, in which case I think we're back to a lot of problems for the world economy.
What do you make, though, of the politics inside of Europe as it relates to how they feel about the U.S. and how they feel about how this could all play out and how much leverage that would give the EU or not to make a deal?
Well, that's a great question, Andrew. Obviously, all of this is seen in the broader context of Russia, Ukraine, what's happening to NATO. Traditionally, the Europeans have been obviously very pro-American, very inclined to cut slack to an American president who might be facing various political pressures. But Mr. Trump is making these aggressive moves on Greenland, for example. They are not happy at all with his attitude towards Ukraine. They regard Mr. Trump as being something, I'm afraid to say, a bit of a patsy with regard to Mr. Putin, because the Europeans woke up some time ago to what Mr. Putin's true intentions are and why he doesn't actually want peace right now in Ukraine under current conditions. So this is a difficult starting point for the Trump administration, but the EU doesn't want a trade war. The EU will definitely do a 0-for-0 deal if that's on the table. That will be a pretty straightforward negotiation. That would bring a lot more confidence and calm, I think, to financial markets. And I think the ball is really in the administration's court to demonstrate that they're willing to negotiate in good faith with the EU. And then, of course, we come on to China, which is going to be much more difficult.
There's a piece in the Journal today, Simon. The president's foreign policy is doing irreversible damage to the greatest geopolitical brand ever created. Is the die already been cast? I'm not convinced that we're past the point of no return on that. And it was also pointed out to me yesterday that I think U.S. GDP's doubled in the last decade or something. Europe is flat. Who's getting screwed? I mean, who's taking advantage of whom? I mean, there's a lot of reasons why Europe is sort of mired in the muck, but that's the bottom line. Is we're doing pretty well globally as a country.
Look, Joe, we're doing great globally as a country. The headline numbers are very strong compared to any reasonable comparison, right? Some people have been left behind, absolutely. We need to do more for them. That's a totally reasonable issue. But the EU has got deep structural problems, which is what you're alluding to here. And they have not been ripping us off on trade. That's not one of the hot button issues. They need to invest more. They need to build more science and technology. They need to get stronger in various structural parts of their economy. We can help with that, but we can help by trading with them more, not by pulling them into a massive trade war. That's going to be bad for them and bad for us.
So then what's this? Why then, Simon? A campaign promise or I have thought, think if it was deregulation, close the border, cut taxes and shrink the size of the federal government. You didn't even have to do this necessarily. And you know, in the midterms, you'd probably gain seats. The whole thing is confounding.
But Simon, one of the things, I don't know if you were listening to that interview with Bessent, one of the things that I found so fascinating was whatever these negotiations are, they may ultimately, in a way, not actually be about tariffs at all. Which is to say,
it can't be. I don't.
No, but if you were listening very specifically, he talked, for example, about could there be some kind of energy deal among some of the Asian countries, South Korea and Japan, for example, in Alaska, and whether you could create jobs in Alaska. And I mean, that has nothing to do with tariffs.
It might all be negotiated.
But the point is, it might be this sort of patchwork of deals, and maybe this is just some way to try to create leverage over the globe. Now, I don't know if that ultimately works, because I do wonder politically whether other countries start to look at this as some other kind of scheme, and I just don't understand it.
Well, look, Andrew, I think Joe's exactly right. That you can make this kind of deal already. Before Liberation Day, you could do energy deals. The global demand for American LNG, for example, is very high and rising. So we can be a stable partner. We can export a lot of energy. We can have a ton of investment in our country in energy resources or in manufacturing. And this was already happening before the massive tariffs were slapped on. So I agree with Joe. I think the tariffs are not just unnecessary, they're massively counterproductive. Best case scenario is we have some long, tedious, drawn-out negotiations which end us back with stuff we could have had anyway. And the worst case is that we destabilize other countries, their financial sectors. There are spillover effects to us. What's the point of that?
Now, EU member states are expected to vote on a final list of products for retaliatory tariffs. That's happening on Wednesday. All right, up next, tensions continue to rise between two economic superpowers as China now vows to fight to the end over U.S. tariffs. A leading trade policy expert with his take when we come back.
The Philippines has been stuck in an infrastructure deficit for a number of decades. Should it not be attended to, it will continue to be our really number one roadblock to sustaining our economic growth. We focus our attention on power, gas, waste management, and water. For each one of those sectors, we try to address a fundamental need. When water is reliable, we have dependable energy, we treat our waste the way it should be treated. Certainly, we create an ecosystem that's more conducive to foreign direct investments and economic growth. Sustainability and growth for us are one. We get things done. We are relentless. We deliver that critical infrastructure. The challenges are significant, but we've created a team that's extremely talented, absolutely equipped to execute.
Don't be a show pony, be the workhorse. I am still growing. I'm loving every moment of it. I'm still looking for new challenges, and I think that's ambitious.
Welcome to Closing Bell. Let's get into the market right now.
Breaking news, market moves.
What it means for your money in the days ahead.
Scott Wapner from the NYSE. Closing Bell, CNBC.
Tiny homes.
Welcome to my tiny house in Atlanta, Georgia.
One woman makes big money with a very little house.
Pretty spacious, honestly.
Plus the Big Apple's version of living little.
My 95 square foot New York City apartment.
And downsizing to unlock a better life by the beach.
No regrets about moving into a tiny house. There's no room for excess or unnecessary objects.
That's all next on Unlocked.
All right, welcome back to U.S. Markets Edition. Tough talk from Beijing as China vows to, quote, fight to the end over tariffs. Now, it's not exactly clear what that means, but these latest comments come as Trump threatens to further ratchet up tariffs on Chinese imports. DeWardwick McNeil, a senior policy analyst at Longview Global, gives his take.
Let's start off with those comments. Really the headline here, the idea that China says they're going to fight to the end. Doesn't sound like they're very diplomatic or really looking to make a deal. When they say they want to fight to the end, what's your interpretation? Is that fight to the end when we're talking about tariffs over 100% or just the increase in tariffs altogether?
I think China is prepared, Frank, to really go a couple of more rounds here. They've been hoping that this would not be the case, but they've been preparing for this outcome for quite some time. As you've heard me say, Frank, I think the Chinese would have preferred to try and go back to something like the phase one trade deal and purchase more goods from the U.S., perhaps semiconductors even, as we know there's some need for some advanced chips. But, of course, that would require getting rid of the Biden export controls. But that doesn't seem to be the path that the Trump administration is taking. And so this is a situation, Frank, where the pace and the severity right now is being led by the U.S., but China is prepared, at least in the short term, to go tit for tat, round for round with the U.S. here in this trade war.
All right, so you're saying at least in the short term, but at the same time, you think that China wants to make a deal. We've also just heard from the president saying he has a great relationship with President Xi. Can you parse that for us? Is that true? Do President Trump and Chinese President Xi, do they have a good working relationship at least? And is some of this bluster, or are they really going to stay resolute?
Well, I think it's fair. It's hard for me to really know, but I can tell you what I believe, and that is he does, in fact, have great respect for Xi, at least for the power that Xi has with respect to his own country. I think he covets some of that own power. In terms of a great working relationship, I'm not so sure I would go that far, but if the president says it, then I'll accept that.
All right, how big of a threat is the idea of devaluing the yuan? Looking right here, since the election, the U.S. dollar has risen about 3.25% against the yuan. Where do you see the potential for the yuan to be devalued to, and how do you think the administration will respond?
Well, as you noted, Frank, in the opening here, the yuan has already moved a little bit below that 7.2 mid rate. I don't think we're going to see much more action with respect to devaluing the yuan. It is a part of the toolkit, without question, but I think you run the risk here of capital flight for sure. You run the risk of actually triggering more ire from Trump and being accused of being a currency manipulator. So I don't see much more room to move in terms of devaluing the yuan. But it is certainly a part of a fuller menu of things that the Chinese will use to try and shield themselves from this tariff war.
Dwardrick, one last question before we let you go. We were hearing from the president of the European Commission, I should say, earlier today, a lot of tough talk coming from the EU, whether it be Germany yesterday or just the EU Commission president today. How big of a threat is it that Europe and other parts of the world, they actually gravitate or move more towards China and away from the U.S. in a very serious economic way?
I think you will see some attempts, Frank, at hedging a little bit. I think for Europe, it may be difficult to really believe that China provides for them all the answers given some of their own internal dynamics. But also think you're going to see China really try to warm up and peel off some of the U.S. allies with respect to this trade war. So I think you're going to see some diplomacy in this space. I'm not sure how well it will work for the EU. They will try. And certainly China will try to really engage more of the U.S. allies.
That was Dewardrick McNeil, Senior Policy Analyst at Longview Global. All right, on deck, Goldman Sachs' tech investing playbook. You'll get it next.
Berlin is a phoenix from the ashes. Yeah, we are the new kid on the block. 35 years ago, the wall came down and we had to start from scratch. We found out, who are we? The answer by our international visitors is, you are the city of freedom. Berlin is adrenaline, and at the same time, it's chill out. If your feet are tired and if your mind is tired of so many museums, impressions, then you can make a turn and you are in Tiergarten. Yeah, it's bigger than Central Park. One of the big trends we see coming is coolcation. If you look at the Mediterranean, many of the destinations become too hot in summertime. And we say, hey, come to Berlin because we have cool forests, cool lakes, cool museums, whatever you need. And a very cool nightlife as well, as everybody knows.
For me, Squawk Box is breakfast with the most interesting people in the world.
It's a privilege to get to talk to them every day.
It's more entertaining than any other morning show, but you might get some useful information.
Squawk Box, weeknights.
The Power Plays are here, breaking down the markets with updates and deep dives. What's moving now and what's next for your money. Sarah Eisen, Carl Quintanilla, Money Movers, weekdays, CNBC.
Every new vehicle we put out, we're improving fuel economy and emissions.
We need a balanced and a fair energy transition for everyone.
The total value chain of battery will be very important.
Improve our operational efficiencies and reduce the consumption of natural resources.
Environmental sustainability is a must, and energy security is another pillar.
Renewable energy is cheaper than electricity made from fossil energy in 90% of the world already today.
Fostering sustainability on CNBC.
To me, ambition is drive. It's the fire in your belly. I didn't go to college right out of high school. I worked full-time while doing school full-time. Somewhere along the way, I got bitten by the journalism bug. No one's going to give you your dreams. You have to roll up your sleeves and work hard to achieve them. Money doesn't make the world go round. Information does. And CNBC is the great economic equalizer because we provide that information so you can make the decisions that are right for you. CNBC is an adventure beyond my wildest dreams.
All right, welcome back to U.S. Markets Edition. Here is another look at how stocks ended their day. And again, not representative of what happened. The markets at one point up more than 4% during the session. The S&P ended down 1.6%. Tech even worse. So again, we were up 3 and 4% to start the day. Then the sellers came in with a couple hours left and once again ended in the red. The S&P 500, folks, now down more than 13% in just 4 sessions. That is the worst 4-day losing streak since October of 2008, the heart of the financial crisis. We saw another record reversal with the S&P giving up that 4% and closing lower for the first time since March of 2020. It was also the second straight day where the S&P 500 swung 6 percentage points top to bottom. That is also something that we have not seen since March of 2020. Bottom line, we like to say the words historic in TV. these are actually history-making markets. And technology is a big part of that. Let's turn to tech, where Apple shares are in the middle of an historic rout. Apple has lost 23% also in just those 4 trading days, wiping out more than $700 billion in market cap. Apple's manufacturing and sales exposure sending shockwaves through investors as they worry about tariffs. And it's not just China. Every other country where Apple makes phones or other products also subject to tariffs. Here is Goldman Sachs co-head of public tech investing, Sung Cho, on CNBC Tuesday afternoon.
I think, first of all, I think they do have more pricing flex in their business model, especially in the U.S., where a lot of the carriers have been subsidizing a lot of these pricing increases, right? So we do think they have the ability to be able to price a little bit better than the market anticipates. Secondly, they do have more flexibility in the supply chain, right? And we're going to figure out where is the right place in the supply chain to build, but they do have a lot of supply chain flex that they're going to be able to do. And then on top of it, they do have a lot of like balance sheet, power as well, right? And then the last thing I was going to point out is, look, from an AI perspective, there's going to be a lot of innovation coming, right? And every innovation, consumer innovation, is going to have to flow through the App Store, right? So to the extent that you believe that applications and new applications are going to take off, it has to go through Apple, right? And so there's a lot of things that they can do to adjust. Right now, obviously, the near term is very, very, wildly negative, but there are things that they can do to respond to make this.
The part of the issue too is, notwithstanding the tariffs, there was already a belief that they dropped the ball related to AI.
Yeah.
You can't just fix that overnight. I hear you when you talk about the flex they may have with supply chain issues. Wall Street Journal reporting earlier today that they could move some capacity to India. But these things don't happen overnight.
Look, I think it's a very harsh statement to say they've dropped the ball on AI. Look, I think they maybe should have been a little bit quicker to respond to it. But most of what we've seen so far is the build out of the infrastructure of AI. And they clearly don't want to be part of the build out of the infrastructure of AI. But they are going to be there when consumer applications really start to take off.
So it's your largest tech holding, correct?
That is correct.
Along with, a number of these other mega caps, Microsoft and Meta, Nvidia, Amazon, Alphabet. I mean, those 6 stocks are your largest holdings out of your top 10.
Yeah.
Where are these things going from here?
Look, tech has led the downturn, right? And we've seen a lot of degrossing activity in the tech space. But you have to look at where valuations were and where valuations are now today. So tech has been about a 20% premium to the S&P 500 over a very, very long period of time. At the top, and when the enthusiasm around AI really got going, we were at about a 30% premium. Right now, we're at a 7% premium. So this is the lowest premium that tech has seen in a long time. And if you step back and say, okay, look at the fundamentals around who can actually drive resilient business models in a tariff type environment, it is the tech stocks, right? And you have to think about it as they have more pricing, they have more competitive, moats, so they do have a little bit more pricing power. They do have cleaner balance sheets to be able to invest countercyclically, and they do have higher gross margins, right? And so I do think tech is going to be much more resilient. I think the earnings estimates for broader tech are going to hang in there a little bit more than people expect. And with the valuations being at a discount, we do think it's a good opportunity on a
thinking
relative
about,
basis.
as I was writing at this, as you say, a 7% premium, right now. If the economic picture darkens, and we rethink earnings numbers more broadly, and we decide that the overall multiple of the market needs to come much lower, then suddenly what is a 7% premium, even if it holds, is lower than it is now.
Yeah.
That's one of the problems.
So the market is basically telling you that the earnings estimate revisions in tech are going to be worse than what they see in the rest of the market. And we just don't fundamentally believe that that's going to be the case, right? The starting point around gross margins is much higher. They have more pricing power. They have the balance sheet to be able to flex. And they have durable growth characteristics like AI. And so we do think that the earnings power is going to likely be much more resilient for tech. And so we do think that that's what's creating an opportunity for investors to start reallocating to tech.
Are they recession-proof?
They're not recession-proof. Look, certainly, like these businesses are economically cyclical, just as everything else is. But we play in a relative world, right? And like I do think right now they have defensive characteristics, but they also have offensive characteristics. Think about that 1 hour where the market whipsawed up. What rallied were a lot of the AI-related names. So there is this pent-up demand to want to own tech. people are degrossing right now, and you can only degross what you own, right? And people own tech. And so we do think that there's a lot of technical forces that are at work as well that are driving some of this correction that's creating an opportunity.
The place where there's been, profound weakness, certainly lately, is the semis.
Yes.
There's also a belief that what was first in, so to speak, is first out.
Yeah.
Some of these have traded a little better lately. Now they're caught up, obviously, in some of the tariff conversation.
Yeah.
How do you see that?
So, look, I think semis have led, tech has led the downturn, semis have led the downturn. I think there's been almost too much negativity now in terms of what's going on with AI and the AI infrastructure build. Right now, we're transitioning from AI models that had very linear types of answers. So you ask GPT a question, and it gives you a very linear response. We're about to go into reasoning models, right? Reasoning models, you ask it a question, it'll remember all the questions that you've asked in the past. It'll also anticipate some of the questions that you're going to be asking. That's the next level of AI that we're about to produce. And we talk about AI agents and all these things. Jensen, more recently, a couple of weeks ago, said that that kind of model is going to require 100x the amount of compute. And so there's obviously more efficiencies coming from Chinese models and things like that. But we do think we're still very much in the middle innings of this build, not in the late innings. And we think that some of the multiples have really retraced to very attractive levels.
Attractive levels. I guess we'll see if the market agrees. That was Goldman Sachs' co-head of public tech investing, Sung Cho. All right, switching gears. Oil prices down, but coal stocks up. A lot of headlines flying around energy. We're going to break it all down for you when U.S. Market Edition comes right back.
Sink this ball into that hole. Sounds easy, but it takes patience and practice to gain an advantage when so many factors affect my game. It's a lot like investing. But with CNBC Pro, I'm never playing the markets. I've got an advantage. Pro's exclusive investor toolkit, plus CNBC's team of global market experts. So for even the most challenging shots, I have the strategy and tools I need to reach my goals. Seize your market advantage with CNBC Pro.
All right, welcome back to U.S. Markets Edition. There it is. On Tuesday, President Trump signing an executive order aimed at boosting the American coal industry. Yes, coal. It's because more energy is needed to power all the data centers and AI. And coal stocks rallied on the news. In fact, one of the few bright spots in the entire market on Tuesday. But those were not the only energy-related headlines. First off, sources tell me that U.S. Energy Secretary Chris Wright is about to head off on a wide-ranging Middle East trip. Secretary Wright will hit Saudi Arabia, UAE, Qatar, and maybe more. It's mostly to discuss oil and gas output, but we'll also talk about investing in the U.S. and investing in nuclear. All of this coming as oil prices hover right around or below $60 a barrel. And many Wall Street firms either cutting their oil price targets or expressing concern about them. Example, Goldman Sachs saying that oil could fall into the low $40 range if we get a worst-case scenario. Their base case is about $55 a barrel here, maybe a little higher in Asia, and into the low 50s or maybe the high 40s next year. Other firms like JCL and Eurasia Group also making comments about demand and the fears about a wider market share war, which could send oil prices down. RBC's global head of commodity research, Halima Croft, joined CNBC to talk about what happens now with oil and energy.
I think the oil market is taking a bit of a breather. I mean, it's been hit by two stories. Obviously, the big one is a concern about recession and, what's going to happen in the all-important demand center of China. But also, OPEC announced last week, surprisingly, they would bring on more production in May. So people were saying, wow, we have a recession potentially looming and more OPEC supply. It was a toxic cocktail. But I think for now, people are waiting to see, is there a potential off-ramp to this trade dispute? And OPEC will be meeting on May 5 to assess what's happening in terms of compliance in the organization.
Yeah. Now, the president has long called for crude prices to be actually even lower than here.
$50 has been his price target.
And we have not really heard much full-throated opposition to that from people who actually work the shale in our Saudi Arabia, so to speak, in the Permian.
Which is so interesting because take a step back 5 years ago when we had the Russia-Saudi price war. And these same shale executives, it was basically hotline diplomacy to the White House saying, look, $30, $40 is going to kill American energy dominance. You need to get the Russians and Saudis back together. And President Trump, the ardent OPEC critic, became the basically OPEC president and got the deal across the line. So we saw President Trump really pivot 5 years ago in terms of what the energy policy should be. I think it's remarkable now that shale executives have seemingly been more quiet in terms of expressing concerns about a $50 price target.
Well, that's because he ran on inflation and he wants to lower inflation and make it cheaper for American households to buy gas.
I understand that, but it's a really interesting dynamic because where we were sitting at the election, it wasn't a particularly painful retail gasoline price environment. And the question is, if your goal is to have massive growth of U.S. production, what is the price that creates that enabling environment?
What is it?
Is there an equilibrium price that potentially works for the U.S. consumer and U.S. producer? I think that's an interesting conversation.
Is there one?
Well, it's always, we always have our pain points. But the question is it $70 WTI? Like, that is a very, very good question when you have Chris Wright on.
Yes, next hour.
The conversation is, what are shale executives saying to you about what they think is the kind of optimal price that keeps demand going, that keeps the consumer strong, but also ensures investment in the shale industry?
Yeah, at a time, you talk about what their costs are going to be doing under the tariffs.
Exactly.
And everything else.
Even if we don't have the full-blown trade war with China, we have the aluminum and steel tariffs. Input costs are going up. So again, another question for Secretary Wright is, how is the industry, even if we don't have the trade war, how are they going to absorb these higher costs?
My guess is, as so many CEOs are talking to me about how important they find tariffs, that you may be hearing it, but not publicly. Fair to say? I mean, do you hear that in conversations you have with the industry?
I mean, we do hear that. We do hear concern about what is OPEC going to do. I mean, I've heard concern from the U.S. industry about what if Saudi Arabia, which has a voluntary cut of 1 million barrels outside the collective cut, just decides to give President Trump what he wants. I mean, President Trump has been asking Saudi Arabia and OPEC, give me more barrels, give me more barrels, give me more barrels. And if they give him what he wants, that's not exactly what I think a lot of shale executives would like at the moment. Now, again, the Saudis are saying, and OPEC is saying, we're going to bring in, 400,000 plus more barrels now in May. We're doing it largely because certain countries within OPEC are cheating. They're not abiding by their quota. It's not about the U.S. It's not about Iran. We're going to review in May. But in the back of people's minds is a concern. Are we back to 2014? Are we back to 2020 when OPEC just turned the taps?
Right. Any thoughts on where we're going from here then on oil prices?
I mean, I think it's going to be so dependent. We wrote a note saying three-body problem. It's going to come down to tariffs, what OPEC does, and the wild card, there's a meeting this weekend in Oman, U.S. and Iran. Do we get a deal on Iran and sanctions removed, bearish for oil prices? Do we get a military strike? Do we get some type of confrontation? It's coming to an end game, I think. Do we get more sanctions on Iran? It can go either way. Pay attention on Saturday.
That was Salima Croft on the energy market and why you need to keep an eye on this weekend's OPEC meeting. All right, here in the States, we call him the Dean of the Stock Market Valuations, in part because he's a university professor who talks stocks. But hear what he told us about market valuations now. That is next.
Let's just get a closer look.
Mom? Nina, wait.
5 immersive worlds.
one amazing theme park. Our universe will never be the same.
Oh, you gotta see this.
Epic Universe, only at Universal Orlando Resort.
My folks, before they pass, give me a very simple to-do list. Get yourself educated at school and also in life. Be successful, but also recognize it's really important how you get there.
Crucial market coverage, actionable insights, can't miss reporting that'll impact the tape and your money now. Be here when the opening bell rings. Squawk on the Street, CNBC.
All right, welcome back. New York University professor Aswath Damodaran, known as the Dean of Valuations for his research on tech stocks, was on CNBC to look beyond Tuesday's market volatility and out toward what he believes could be a radical redistribution of global wealth.
It feels like the beginning of a shakedown. I mean, it's, I remember crises past, and the first shock is not always the end shock. There are aftershocks, as you saw today. While I've been waiting here, the Dow swung 150 points in either direction. And I remember, weeks like these after 2008 and 2020, where the market can't find a steady state. And I think that the potential for these tariffs to create long-term effects in the economy is such that you can't say the market's panicking for nothing. There's a real reason markets are reacting the way they are. And until we get some sense of what steady state looks like, this looks more like a markdown of equities than panic selling to me.
I'm wondering, from all the markets that you've seen and the way you study them, whether you look at a market downturn differently when you have something as unprecedented, I think, as you've had now, where you've had, as I've said, a self-inflicted crisis from the White House, from the very hand of the president himself, which has caused this level of market upset, versus something over a period of time that just crops up and becomes an issue that the market gets concerned about. The unwind of the carry trade back in August, for example. Yeah, that felt pretty bad, and the market looked bad for a bit. Do you judge the two differently?
No, I think, COVID was unprecedented. We've never seen anything like that. The collapse of Lehman, it's not that it's unprecedented, but that it has the potential to change the global economy long term. I think that's what sets us apart from COVID, is this could change both the size of the global economic pie and who gets which slice, which is one reason I think it's tougher to call this than another crisis. You don't know how this whole process is going to play out. Because I wouldn't be so quick to judge the market and say, hey, the market's just overreacting. There is real change coming, and the market is trying to price in that real change.
But that's the great unknown. I mean, if they believe that they're trying to reset the global economy, and let's just take that at face value, and we say, okay, I buy that. You're going to have higher costs here in the U.S. to produce goods. You're going to have higher wages paid to the workers to produce those goods. You may not have the pricing power you once did. So therefore, your margins are never going to be what they once were. Thus, your earnings are going to be reset lower. Thus, the market multiple, I would assume, must have to be corrected lower, too.
And you know what? The White House may be okay with that, because from what I've heard in the last 5 to 7, it looks like the end game for the White House is not so much what equity markets will do, but what the slice of the pie is that the rest. I mean, let's face it, for 40 years, the slice of the overall pie that equity investors got got larger and larger. And it created consequences. And I think in many ways, I'm not sure the White House cares that much about the market slice of the pie. If some other group that they feel is, waited a long time gets a slice of the pie that's larger than it used to be. So that's what makes it feel different. Usually in a crisis, the Secretary of the Treasury is out there trying to calm markets down and, essentially soothe fears. This seems to be the exact opposite. So I'm not sure what the end game here is. And it's clearly keeping the equity market going up doesn't seem to be on the top 5 list of things that the White House is concerned about right now. And if you're a player in the market, that is a problem for you because you're no longer on the top of the list as somebody they care about.
I get it, but what is the slice of that pie? Making a widget for a low wage in a factory that's suddenly brought back to the United States?
That's the real end game, is how much smaller will the pie get? Because the global pie will get smaller. If you make global trade more difficult, the global economic pie will get smaller. And the U.S. as the largest player in that market will also see a smaller pie. A less robust economy in terms of who'll get which slice, I'm not sure that anybody's going to get a slice bigger than the slice today at the end of the process. But the White House seems to believe otherwise.
Now, Nadamoto went on to say that while he is not actively buying stocks right now, he is eyeing some high-flying software names with what he would consider more attractive valuations. All right. As we prepare to say goodbye, let's get a final look at the crazy finish for stocks here in the United States. Again, this chart not telling the story. Dow, S&P, NASDAQ, and our small cap Russell 2000 all lower. But the S&P 500, as we noted, at one point was soaring. And in fact, as we said earlier in the show, this is the first time in 5 years that the S&P 500 went from up 4%, or moved, I should say, 4% intraday since COVID first hit. Now, what about Apple? Well, Apple, obviously the biggest and most important company, or one of anyway, in the world. A lot of you may be watching on your iPhones or MacBooks right now. Apple down another 5% today, and in just 4 trading sessions, Thursday, Friday, yesterday, and Tuesday today here in the States, Apple has lost over 20%, its worst run, 4-day run, since 2008. And by the way, Microsoft, with that move, Microsoft is now back on top as the world's most valuable company. But hey, let's see what Wednesday brings in the U.S. markets. That's it for us here on U.S. Markets Edition. I am Brian Sullivan. Squawk Box Asia up next.
First on world markets, first to the global business conversation. Get a jump on the investing day every day with Frank Holland. Success starts early. Worldwide Exchange, CNBC.
You're French, the son of 2 physicians, grew up in a family where you're focused on medicine and life sciences. How would you describe your leadership and your management style?
I'm very collaborative. I don't like consensus, which was something we changed.
You don't
in
like
the company.
consensus?
No, because I think that consensus is slow first, but also sometimes impossible to reach when you have a tough decision to make. So often everybody agrees, but if there is no consensus, it's not a reason for not making a decision. So very collaborative. I try to have a lot of proximity with people. I am very approachable. I want to be very inclusive. I empower a lot the Takeda executive team. So again, I think creating a culture of performance, but respect and inclusion and collaborative.
We're moving from the autopilot era of AI to co-pilot era of AI.
We are just at the dawn of the robotics age.
The more experience you give it, the more capability this AI model can achieve.
Hopefully improves productivity, and it doesn't displace more jobs than it creates.
How to maintain our humanity if we live more and more digital lives.
The new era of tech.
On CNBC.
There's a difference between ambition and greed. Greed is wanting more.
Ambition is wanting better, and not just better for yourself, for your family, for your community, for your country. There's no reason to want CNBC if you're not ambitious, right? If you don't want better insights, better returns. And that's not just financial, though money is a part of it. We're talking about value.
Good morning, everybody. I'm Sherry Kang in Hong Kong.
And good morning, folks. I'm Martin Sung in Singapore. These are your headlines this hour. We are counting down to midnight Eastern. Right now, it's T-minus 5 hours because at a second pass, China is going to be creaking under a total 104% U.S. tariffs. Ahead of that, futures are nervous. They are edging lower. Before that, Wall Street did a sharp U-turn, giving it up. The S&P below 5,000 for the first time in a year.
Meantime, China is not coming to the table, digging in at its heels, promising to, quote, to fight to the end. How bad could it get? Well, the renminbi did drop sharply overnight. Some folks are calling on 8-handle.
And oil sinking even further on the risks of a full-blown trade war and possible recession, which would hurt demand. Brent down 4% overnight, below $63 a barrel. That is a 4-year low. So, good morning, Sherry Kang. Huge U-turn on Wall Street overnight, huh?
Classic sort of bear market to bounce back kind of behavior. And of course, at that U-turn, people wanting to get optimistic, and then they just realize they just don't have anything to be optimistic about at this point in time as the U.S. is forging ahead with the tariffs. And checking in on U.S. futures, we do have hours to go till the cash trade, but let's take a look at the preview. The setup is looking negative. NASDAQ is called down 187 points lower as we speak, and Wall Street's closing deep in the red. Following another choppy trade overnight, as we just pointed out, the S&P 500 now back below the 5,000 mark. That it is the lowest level in a year. Oil prices also slumping overnight on recession fears as Beijing butts head with Washington refusing to back down from Trump's tariff war. Brent settling 4% lower overnight. And right now, we've got 62.82 for that. WTI also lost about 2.5% in the U.S. session. We've got 57.86 as we speak. Marty?
All right, and our top story, we are less than 5 hours away from 104% tariffs kicking in on China. Let's get right to CNBC's Eamon Javers with the latest in D.C. Eamon?
Yeah, good morning to you guys. The White House has been insisting all day here in Washington, D.C. on Tuesday that they are going through with the 104% tariffs on China. There was some question earlier in the day about timing of all that, and the White House said, no, this goes into effect midnight East Coast time, so that is about 5 hours from now. Some mixed messaging, though, from the White House as to what the overall goal of this tariff program is. You've got Peter Navarro, the trade advisor inside the White House, saying publicly and on CNBC that this is not a negotiation. This is a permanent state of affairs designed to restructure the entire global trading order. And then you have Scott Bessent, the Treasury Secretary, who was on CNBC earlier today describing this in a very different way and very much as a negotiation. Here's what he said.
If we're successful, tariffs would be a melting ice cube in a way, because you're taking in the revenues as the manufacturing facilities are built in the U.S., and there should be some level of symmetry between the taxes we begin taking in with the new industry from the payroll taxes as the tariffs decline.
So there you have the Treasury Secretary describing this in a very different way. Navarro saying it's permanent, but the Treasury Secretary, who is a more senior official, saying that no, it's more like a melting ice cube. The idea here is that as the U.S. government negotiates individual deals with individual countries, they can pull some of those tariffs off and get those tariff barriers down towards zero over time. That implies there is a massive global negotiation going on. So far, we know that the South Korean delegation is sending a team to Washington to negotiate. The Japanese are sending a delegation to Washington to negotiate. But we don't have a list of the other countries that are engaging in negotiations at this point, although the White House has said that they have upwards of 70 countries that have expressed interest in that negotiation. One thing I should point out, though, at this hour, and it's now just a little bit after 7 p.m. East Coast time, we don't have the paperwork yet from the White House to show that the president has signed the additional 50% tariffs on China into an executive action. So there will be required some documentation and paperwork on that. He has said it on social media. He has said it publicly. But what we haven't seen is the actual documentation of that additional 50%. Remember, the additional 50% came from Trump after China retaliated to Trump's initial tranche of tariffs. So we're now sort of 3 links of the chain into the tit-for-tat retaliation. The White House has not shown us the paperwork, but I talked to an official there today who said that will be executed and those tariffs will go into effect tonight, guys. Back over to you.
Thanks for pointing that out, Eamon. And just, I want to get your sense of how Washington is reading Beijing's response so far. Rather swift retaliation announced on Friday. Is there any sense that perhaps Washington was off guard? And, of course, the rhetoric has been pretty strong from China as well.
You know, officials at the White House have said that they've warned countries not to retaliate. But you do kind of wonder how they could not expect a retaliation from the Chinese and how they could expect that the president's social media post about the 50% additional tariff would get a favorable response. I mean, you would imagine that for Xi Jinping, the political pressure would be on him domestically if he were to cave into a tweet like that or a social media post like that. So putting the government in Beijing in a position like that doesn't seem to be the way to get to a favorable deal with the Chinese government if that's their objective. It seems like the objective from Washington was to put these tariffs on, put them on hard, and really slow the bilateral trade relationship between the United States and China. That they feel in the White House that over a generation, American manufacturing has been outsourced to China, and this has had devastating consequences for folks in the American heartland communities across this country where you've seen unemployment, drug abuse, and all sorts of social ills. And they argue that these tariffs are going to go a long way to solving that problem.
Okay. Eamon Javers joining us live from D.C. Thank you very much. So, as Eamon was saying, the paperwork, that executive order, that is coming. But meantime, China is not budging. But as Eamon was pointing out, a team of senior Japanese officials are set to kick off talks with the Trump administration in D.C. Let's get to CNBC's Kaori Anjoji, who's following the negotiations from up in Tokyo. Good morning.
Good morning, Martin. Well, 5 hours, of course, the clock is ticking with the Japanese exports facing 24% in tariffs, 25% for the auto sector, which makes up 30% of Japan's exports. Shell-shocked Japan may be, but ill-prepared it was not. Instead of retaliatory measures, it took a very quiet approach, and things were moving in military precision yesterday. So here's what we know about everyone who's involved in these negotiations, and I mean everyone, because on the right-hand side, if you put up that diagram, you have Minister Kato. He's, of course, going to lead the discussions with the Treasury Secretary. On the left, you have a gentleman by the name of Mr. Akazawa, a very quiet-spoken man, but going to be leading the negotiations with the U.S. Trade Representative. But those two are by far not the only people. They are just the faces of this negotiation. Behind the scenes for weeks now, bureaucrats have been working to try and negotiate with the U.S. administration because that culminated in that very coveted call between the Prime Minister Shigeru Ishiba and President Donald Trump. And what they're trying to do is trying to hammer out a package because I've been to many countries, but in Japan, FaceTime is everything. And the Prime Minister Ishiba has said after those negotiations wrap up, he wants to visit with Donald Trump in Washington. Martin?
Carrie, I have to ask you, the composition of the team, the Japanese team, what does that tell us? Because I noticed that the trade minister, and this is about tariffs, right? Trade Minister Muto, he's been to D.C. a couple of times, tried to get tariffs lowered, didn't work. But right now we've got the finance minister and the other gentleman. Does it suggest that the negotiations are more likely to be about Japan lowering some of its non-tariff barriers?
You know, Martin, I think everything is on the table, and by that I really mean everything. But the problem is when you look at the breakdown of Japan's exports to the U.S., which amount to about 21 trillion yen. I mean, you look at the list. I'm going to look at the sheet here. The top export is automobiles by far. It's 30% when you take a look at auto parts as well. Now, we talked about this a little bit yesterday. Voluntary export restrictions could be on the cards, but here's the problem for Japan. It's going to push Japan into recession. That's what people are worried about. So you want to look on the other side of the table, which is imports, U.S. imports to Japan, because Donald Trump has said he wants better access. But when you look at that table, the top percentage in terms of imports into Japan are pharmaceuticals. The next one I think is interesting. It says industrial products. We're talking about power systems. So here's what the Treasury Secretary had to say to give us a little bit of flavor as to what they may be looking for. We have that
Thank you very much, Carrie, for that. And of course, yeah, we don't have the soundbite ready just yet. And of course, you make a great point that everything is on the table, and pretty much all these countries that are hit by a country-specific, of course, tariffs by the Trump administration is basically trying to engage with the U.S. and flying out there. And Japan is not the only country. I do want to get to a South Korea angle in all this, Kaori, as well, and Marty. And we're also getting some flashes out of South Korea saying that is vowing efforts to ensure that domestic automakers are not treated in a disadvantageous way. They are talking about the support of 15 trillion Korean won this year alone, and they're actually upping that number from 13 trillion Korean won. So there is that. And obviously, auto is one of the hardest hit sectors in South Korea, given the, of course, the auto-specific tariffs that the U.S. is putting on certain countries here, or actually across the board, I should say. Let's talk about what we learned from overnight, because there was that phone call, finally, President Trump and acting President Han Duck-soo of South Korea. This is the very first time for him to engage since taking his office. Right after his election victory, there was that phone call with now ousted President Yoon Suk-yeol. Things were good back then. And then, of course, South Korea doesn't really have a leader at the moment, despite the fact that the acting president, Han Duck-soo, did manage to get a phone call this time around. What we learned from the White House side is that they're prioritizing allies in tariff talks. So I think that is a big takeaway. For countries like South Korea, I think shipbuilding and energy deals could be potential areas of focus. In fact, Han Duck-soo gave an interview to CNN saying that he would like to negotiate with Washington. He's not going to band together with China and Japan to sort of beat the tariffs or retaliate. I think that was an interesting point to Marty as well. Yeah. So this is one of the points that we were talking about earlier this week as well, yeah?
That's right, yeah, because, you know, at one stage it sounded as though it was going to be a three-way trilateral sort of approach, Japan, South Korea, and China getting together to respond to the U.S., but now looks like Japan is going its own way, Korea is going its own way as well. You mentioned cooperation, potential cooperation in shipbuilding. That's one thing. Obviously, another way that South Korea could address the trade imbalance with Washington is, of course, buying more U.S. arms.
Oh, yes, definitely. And I think it's just increasing imports from the United States altogether. I think that could actually sort of balance things out here. And that's actually what the trade minister in South Korea, who should be in Washington as we speak, did say to reporters earlier, well, actually just overnight as well. So we'll definitely be watching. But I think the starting point is quite tough for the trade minister because he really needs the Trump administration to understand that they have a bilateral free trade agreement. So the tariff calculation itself coming up with a 25% number, that's not correct. South Korea is trying to explain that. Let's see if the Trump administration, I don't know, hears him out.
Yeah, the math of the numbers can often get confusing, understood. So, Sherry, as we've been talking about, China isn't backing down despite those 104% U.S. tariffs, which are set to kick in just after midnight Eastern, which is noon Hong Kong, Singapore time. And that is our big number today. Again, that means imports from China into the U.S. get hit with a total of 104% tariffs if China does not scrap its retaliatory tariffs of 34% on the U.S. But, Sherry, talk about confusion with the numbers. Some folks remember back to Trump's first term and go, hold on, wasn't he the one that sort of kicked off this whole trade war with China by slapping tariffs of up to 25% on some products? And if you work that in, it gets more like 129%, close to 130% tariffs.
Exactly. And this is the very point folks at the Peterson Institute were pointing out as well. So they're going with additional 20.8%, and that's a rough number. And this is a number that could be different for different products as well. But we're not talking about 104. We're talking about 120-something% on Chinese goods imported to the United States. Just as a reminder, the tariffs that did exist before the Trump second administration began here. So I think just because of the sheer number itself, the big number itself, that I think many in the markets and the world are actually questioning how sustainable, how real, how serious this can get. And I think, we just talked about the market, the U-turn that we saw on Wall Street. Maybe in the beginning that people thought that, come on, the Trump administration cannot go ahead with this. And then Trump says, we're forging ahead. And I think that could be another layer in the U-turn that we saw on Wall Street overnight.
Yeah, it looks like yes, it can. Anyway, all right.
Yeah. And, of course, we got lots to speak about, of course, today as we approach that critical mark. As Curry pointed out, we're counting down less than 5 hours. And later, we've got S&P Global Ratings, the global chief economist, Paul Grunwald, on U.S. recession probabilities. And later in the show, Rishar Sharma, of course, Rockefeller International, talks to us all about what he thinks went wrong with capitalism. All of that on Squawk Box Asia. Stay tuned. We'll be right back.
Squawk Box is breakfast with the most interesting people in the world.
The ultimate pre-market morning news show. Squawk Box. CNBC. Real money, real debate, real-time moves. Scott Wapner and the Halftime Committee break down key trades. Get an edge on the market's next move. Halftime Report, live from the New York Stock Exchange. CNBC.
Tiny homes,
Welcome to my tiny house in Atlanta, Georgia.
One woman makes big money with a very little house,
Pretty spacious, honestly.
plus the Big Apple's version of living little,
My 95 square foot New York City apartment.
and downsizing to unlock a better life by the beach.
No regrets about moving into a tiny house. There's no room for excess or unnecessary objects.
That's all next on Unlocked.
The Bond Report is brought to you by PIMCO.
Welcome back. It's a midweek Wednesday here on Squawk Box Asia. I want to show you how treasuries are pricing. Take a look at the benchmark 10. We are up almost back at 430 right now, believe it or not. Short end twos at 372.97. So the head scratcher is this. We have lost such an incredible amount of ground in equities, yet the 10 is back where it was before Liberation Day. So go figure. CNBC's Rick Santelli has the latest in today's bond market report. Take a look.
Good morning, Asia, Australia, New Zealand. Well, tomorrow we start to get some economic data, wholesale inventories and trade, and then later in the afternoon we'll have the minutes to the last Fed meeting. The big data points, of course, are going to start on Thursday. And on Thursday we're going to have CPI, and on Friday we're going to have PPI. Those are the biggies of the week. As far as today, well, what we did have was the first of three auctions. We had a 3-year note auction, $58 billion, and it did not go well. Very weak demand, it tailed, and it turned the market. After 1 o'clock Eastern results, interest rates went from slightly lower on the day to higher on the day, and it was led by long maturities, and the curve steepened to over 50 basis points for the first time in 3 years. Actually, February of 22, a little over 3 years. If you looked at the equity markets, they were super strong early in the day, and as the notion of tariffs in China became the talking points of the day, it started to lose ground. It did manage to get some green back, but nowhere near the amount of green, especially in the Dow, that it had earlier in the session. When you do look at interest rates, not only did the curve steepen, but what we really want to talk about is how long rates have gotten so much more buoyant. And remember, as we focus on tariffs and try to divine if it's a one-time inflationary shock, if it happens at all, or is it more of a lingering effect? Well, we really don't know that outcome, but when you have debt and deficits the way we do, a weak 3-year note auction and 10s and 30s to follow, it certainly seems as though the longer maturities are much more alive to the upside than they have been. And I think we want to pay very close attention to not only did we hold 4% on a closing basis this week, but we are now at that 4.25 level. And should we start to close above that after having exactly a 4% low yield close on this move, that would go a long way on the technical side to bring in more selling. Reporting from the CME HQ, I'm Rick Santelli, CNBC Business News, Chicago.
The Bond Report is brought to you by PIMCO.
The day's top stories driving Wall Street. Up to the minute developments. Kelly Evans, Brian Sullivan, Power Lunch, CNBC.
Ambition means to me the drive to succeed. When I first stepped in front of a camera, I felt I was home. I interview leaders from different industries who all have the same mission: to make a difference to people's lives.
You're back on Squawk Box Asia on a midweek Wednesday. Let's get straight to Paul Grunwald, Global Chief Economist at S&P Global Ratings, joining us live. Paul, great to see you again. Always a pleasure having you on the show. So we're counting down to a total of 104% tariffs on China, set to kick in a second past midnight. Some folks think the numbers should be actually even higher when you factor in the tariffs that President Trump dropped on China during his first term. But, regardless, these are huge numbers we're talking about. My question to you is, can China handle this, given that its exports to the U.S. account for less than 3% of its GDP?
Yeah, well, thanks for having me back on the show. Well, obviously, we're on uncharted territory now with the level of tariffs. But, when we're thinking about countries and how they might respond to the U.S. Raising tariffs, we've got a small number of countries or economies. China's one, the European Union's probably another one, that are likely to try to retaliate and do this kind of tit-for-tat strategy. So we know that some of the smaller economies in your region, like Vietnam, don't have a lot of bargaining power with the U.S. But, China was very quick to respond to match the 34. They're going to see another 50. We'll have to see if this game continues to play out. And remember, the tariff is like you put a higher price on your own citizens, and then you get sort of the political blowback on that, which is a very funny dynamic when you think about it. But we'll see how both sides continue to play out. But as I said, uncharted waters, and we'll have to just watch the dynamics and including the politics and see what happens.
And Paul, this is a rather regular exercise for every single tariff episode between the U.S. and China. But which economy is better positioned to fight?
Yeah, there's the economic measure, and then there's the political measure, and those are kind of different. Everyone loses from tariffs, right? You're kind of shooting yourself in your own foot, in the sense that most of this comes back and is paid by domestic consumers. So we know that from an economic point of view, there are no winners. I guess this is kind of like a game of chicken now, right? We keep getting escalations from one side that are matched from the other side, and we'll have to see, who blinks first, or maybe we can find a path to de-escalate, which would be the good scenario in our point of view. But it doesn't look right now like any side is prepared to blink. So again, got to see how this plays out and see if we can find a path to de-escalate.
And we got a lot more with Paul Grunwald. Paul is staying with us. We are going for a quick break here. Squawk Box Asia is coming right back.
Mongolia has been always the nomadic people since the very beginning. Being nomadic is so, inherently connected with the environment. The nomadic people, we are moving to place by season. The natural environment is in our DNA from Mongolians. The social media tools is so important for promoting the tourism. We also collaborating with Trip.com, TripAdvisor, and last year we were collaborating with Nas Daily. They bring so many influencers just for promoting Mongolia, and then he became our tourism ambassador on the internet.
You want people to trust their money.
This is the market that we're operating in. They need to drive their plans forward.
We need to pursue new business opportunities.
You're always better off having a fortress balance sheet.
Prudent fiscal policy can contain debt.
You're going to take less risk to get to your target now more than ever before.
Making sense of the global economy. CNBC.
I strive to be intellectually ambitious. I want to be making connections,
finding the right data so I can help our viewers see around corners. I'm based in Los Angeles, and talking to VC investors or Hollywood executives, I have a unique perspective on what's going on in this incredibly fast-changing world. I love being a business reporter. In covering technology, I'm reporting on change. Ambition can create change.
Time check, 7:30 a.m. Hong Kong, Singapore time. So we are less than 30 minutes away from Tokyo coming online. Futures are handicapping what looks like another negative start again. Dollar yen, we're changing hands at 145.67 as we speak. And futures are up and running and rolling. U.S. futures at this early juncture Wednesday in Asia, handicapping. Looks like more downside when Wall Street gets back up and running tonight, Asia time. Sherry?
And we are back with Paul Grunwald of S&P Global Ratings. Paul, thank you for sticking around. I want to get to the yuan question after that warm-up on China. You recently made a point of how the Chinese yuan has really made a lot of progress as a trade currency, really going out into the world through a lot of initiatives and doing a lot of trade and a lot of trades taking in place in RMB. How does that work in this particular tariff dynamic? Does it pressure Beijing not to devalue, even if there is an impulse to do that right now?
Yeah, I think that's a correct characterization. The RMB is still mostly a trade currency. It's not a store of value. It's not a reserve currency. So, if we're going down the trade war path, which we certainly are on, this could widen to include services. It could widen to include sanctions. It could widen to include the currency. So the currency weakening as another weapon is something that could be employed. But again, we're on this path now, and I think at some point everything's going to be in place. So again, we're gonna watch and see how the tit for tat evolves and whether it broadens beyond goods trade. There's no reason to think that it may just stay in that very narrow lane.
If Beijing were to do this, devalue its currency to, raise the appeal of its export items pretty much around the world, how will they carry that out? Just for the last couple of days, well, actually Monday and Tuesday, we've been seeing this midpoint yuan fixing, and one of the guests earlier this week described it as a messaging that here we go, this is what we're attempting to do. Do you agree with that?
Yeah, well, the midpoint, I'll put on my Asia hat since I spent a lot of time in the region. The currency is not free floating, so that midpoint, that set is a signaling device, right? And if the authorities are intending to weaken the currency, they can use that midpoint as a signaling device. I'm not sure that there's a big export advantage to weakening the currency. There's a question about the price sensitivity. So I think that was once upon a time, maybe that worked better with China, but I'm not sure you get a ton of bang for the buck on your export weakening the currency. It's part of the toolkit, but I wouldn't expect that to be sort of the main measure as we kind of go down this escalation path.
Hey, Paul, let me quickly jump in here. I mean, the midpoint always on weekdays is set 9:15, so we've got a little while to go before we see what they do. But so far, the last 2 or 3 settings, they've moved in baby steps, right, to let the currency soften. Is it too early to tell what their real intentions are, whether or not we're looking at a potential, repeat of 2015 when we had a big one-off devaluation? And of course, this was during Trump 1.
Yeah, I mean, that would be sort of the big thing to watch, right? Kind of the weaponization of it. If you get a very large downward move, I think I don't track it personally on a day-to-day basis, but I think, describing sort of baby steps right now, maybe directionally sending out a signal is kind of the conservative. If you wanted to really send a message, I agree. You do a fixing that was much weaker, and that would sort of signal that the currency might be in play.
Paul, I got to ask you a broader question, right? Right now, the approach that China is taking is it's the only economy which is not caving. It's not trying to come to the table, asking for meetings or phone calls. It's digging in its heels, right? We've seen the 34. Okay, 34 back at you. What is the risk that this could go even broader and become a full-blown, fuller spectrum sort of confrontation between the two sides? I mean, right now we've got goods. Does it go into currency? Does it go into services? I mean, how bad do you think it could get? I'm thinking here also of whether they could weaponize their holdings of U.S. Treasuries.
Yeah, well, I think, again, it's starting in this narrow lane of goods. Even the Europeans have floated the idea of, some sort of action on U.S. services. You know, the U.S. is a surplus service exporter, so I guess there's more vulnerability there. But, I don't have the playbook in front of me, but certainly is if we go down the road and, we're past 100% now on tariffs on both sides, if the Chinese respond to the next one tit for tat. And I think, again, everything is potentially in play. Services potentially in play. Currency as well.
And obviously, the big question that we're asking this week is how will these tariff negotiations will go, and what all these countries can put on the negotiating table at the moment. We don't really know a lot of answers at the moment. Having said that, Paul, what would be the implication going forward for these tiger economies, such as in Asia, such as South Korea and Japan, that have been really working hard to build that alliance, a strategic alliance with the United States? I would imagine they are busy negotiating at the moment. What would be the impact from the 26% tariff if they actually hold for a while?
Sorry, if they actually held for a while? Is that the question?
Yeah.
Yeah. Well, the pain is going to be, probably back on U.S. consumers. So the price of imports from Japan and Korea are going to rise, and then all the trading partners are going to rise. And the question is, how much of a dent is that going to put on? How much of a dent is exports from Korea and Japan into the U.S. market? If this is kind of a nominal event, and U.S. prices go up and the tax cuts go, and we don't. A material slowdown in the U.S., that's a kind of an episode where the U.S. consumers actually have part of the pain. The distribution of the tariffs is key, and we're thinking a lot on my team. Do the consumers in the U.S. pay the tariffs? Do the exporters pay the tariff? Or do the importers into the U.S. pay the tariff in terms of margin compression? If it goes back into margin compression on the exporter side, which would be sort of the pain on Korea and Japan, that's where, you could maybe get them to the table. But it's not clear because empirically, I think most of this stuff passes through to final consumers in the U.S.
Paul, listen, let me quickly jump in. The president is speaking at the NRCC dinner. Let's pause and take a listen.
Yes, not bad.
All right.
I wonder if you ever turn the room this way. It's interesting because I love real estate. I love ballrooms. I have nice ballrooms, a lot of them. I wonder if they ever turned it this way instead. So it might be interesting. This way I'm not talking to a wall. They think they get a better view, but actually I'm not sure. But next time, maybe we'll have to worry about that next year. Well, we'll do 45 or 50 million, right? I mean, a lot of people, you broke your record attendance and you broke your money record, and that's a great tribute to the Republicans and the party and everything it stands for. And it's wonderful. And I want to thank especially Speaker Mike Johnson because he's been incredible. And we have some unbelievable supporters of our House Republican majority with us, as you know, and with the help of everyone in this room. The next year's Republican Party is going to defy history. We're going to really defy it, and we already are. We're getting things done. It's going to be very interesting to see. This is going to be a very interesting year. We have an interesting time. We're making a fortune with tariffs, $2 billion a day. Do you believe it? I was told $2 billion a day. I get hit by the press about tariffs. We're making $2 billion. This isn't 35 million, that's peanuts. $2 billion a day. And then they say, gee, they don't know. This is only the enemy can be talking this way. In addition, we have a lot of countries coming to see us. They want to make a deal. And we're doing things that nobody's ever even thought about doing. And we're going to defeat the radical left Democrats who are out there complaining about everything. All they do is complain, and then they want to put men and women's sports and things like that. They want men and women's sports. They're still fighting for that. I saw this poor guy. You all know him. I won't mention his name. He's sort of a nice guy. He's a loser. He's a Democrat, but he's a loser. And he was fighting on a big show this morning. We've got to have that. It's not fair that, essentially, that men aren't allowed to compete against women. Can you believe this guy? But let them do it. I say we shouldn't be fighting a lot of these things. Just let them go. And then just before the next election, we'll unleash on them. Because it would be very sad if they actually changed their policies. We don't want that to happen. But we're going to win the midterm elections, and we're going to have a tremendous, thundering landslide. I really believe that. And it's so important that we pass the big, beautiful bill, because that's going to be. And I really think we're helped a lot by the tariff situation that's going on, which is a good situation, not a bad. It's great. It's going to be legendary. You watch, legendary in a positive way, I have to say. It's going to be legendary. But I really think it actually puts pressure on those few Republicans that just can't get there. You know what the alternative is? A Democrat bill or a chapter for the country. We have the debt continuation. And they have to do this. They have to get there. And I think we are there. We had a great meeting today. I think we are there. But just in case there are a couple of Republicans out there, you just got to get there. Close your eyes and get there. It's a phenomenal bill. Stop grandstanding. Just stop grandstanding. Boy, oh boy, oh boy. Their policy, the Democrats, is horrible. It's horrible. Think of it, open borders. Just all of the horrible, stupid things they have. You don't have energy. You don't have anything. They've lost their confidence. Everything is bad. But the one thing, they always vote in unison. You don't see somebody that's holding up. I'm going to hold up. And the alternative is hell. The alternative is hell. So the Republicans just have one little thing.
Just listening to President Trump there speaking live at the NRCC dinner, repeating his line that tariffs are generating $2 billion with a B in revenues for the U.S. government per day, he's stressing. All right, I'll continue to monitor that speech. Meantime, let's get back to Paul Grunewald, still with us live, S&P Global Ratings, and the impact of tariffs, Paul, on China. I'm not sure where you put the growth for China, whether it's 4% or below. Goldman is at 4.5% GDP growth for China. And it says, come a second past midnight, if that extra 50% gets slapped on, that number goes considerably lower. How low does it go for you?
Yeah, actually, our latest round of forecasts got derailed by Liberation Day, so we're taking another look. We were at 4.1 for China. We're probably going to be moving that lower. But also we're going to be moving the U.S. lower as well. It's not clear, which one gets dinged more. Again, there's no winners in a trade war. So I think both sides are going to see lower growth and higher inflation forecasts in our next round, and probably lower employment as well. So again, it's kind of a domestic pain threshold game, because you've got pretty symmetric damage on both sides. And if you continue to go down this road, the damage gets bigger. So again, we're going to see how the pain meter goes, and who's going to blink first, and whether there's an off-ramp.
And, with President Trump wanting to bring a lot of capacity, manufacturing to the United States, Paul, there is this new narrative around what can be brought to the United States. And people were talking about the example of Hyundai Motors, a new plant, of course, in Georgia. And people were saying that this doesn't really create a lot of jobs out there, but it's really robots building cars. Do you just have a line on how the automation of a lot of manufacturing could be something that is, overlooked by President Trump?
Well, I have to go probably to the auto experts for that. But, obviously we already have the Koreans producing cars in the U.S., the Japanese and the Germans. BMW is actually the biggest automotive exporter from the U.S. I would think part of the potential negotiation is over, doing more manufacturing by foreign automakers in the U.S. It does generate local tax revenue. It does generate employment. But let's remember that, U.S. manufacturing employment has been falling for decades. German manufacturing employment has been falling for decades. Chinese manufacturing is now falling after it peaked. So, as countries develop from agriculture to manufacturing to services, manufacturing employment falls. I mean, that's just part of the deal. So there may be some reshoring for industries that are already working or producing in the U.S., but for a lot of trading partners, there's very little prospect of bringing things onshore in the U.S. And then it's going to be, who eats the tariffs? And most of the evidence suggests it's going to be U.S. consumers who are going to pay that.
Thank you very much, Paul, for joining us today. That was Paul Grunwald of S&P Global Ratings. Squawk is going for a quick break. We'll be back in 2.
Ambition creates motivation and power. Motivation to take risks and challenge oneself, and power to find solutions and solve problems. When you reach your goal, that makes you want to go farther in the future.
Frank Holland, Worldwide Exchange, CNBC.
You're French, the son of 2 physicians, grew up in a family where you're focused on medicine and life sciences. How would you describe your leadership and your management style?
I'm very collaborative. I don't like consensus, which was something we changed.
You don't like
in the company.
consensus?
No, because I think that consensus is slow first, but also sometimes impossible to reach when you have a tough decision to make. So often everybody agrees, but if there is no consensus, it's not a reason for not making a decision. So very collaborative. I try to have a lot of proximity with people. I am very approachable. I want to be very inclusive. I empower a lot the Takeda executive team. So again, I think creating a culture of performance, but respect and inclusion and collaborative.
For the 4th consecutive year, Interactive Brokers is one of the fastest growing prime brokers and is now number 5 in Preqin's ranking of top prime brokers. Interactive Brokers serves both organizations and individual investors. To get better results, get a better platform. The best informed investors choose Interactive Brokers.
This FYI is sponsored by Interactive Brokers. Direct market access to stocks, options, futures, forex, bonds and ETFs. One world, one account.
Next to report earnings. The airline cut its guidance back in March, but analysts are expecting the airline to show strong results for the first quarter, which is typically the slowest quarter of the year for airlines. Constellation Brands is due to report earnings after the market close. Plus, the Federal Reserve will release its minutes from its March meeting, where the central bank decided to keep interest rates unchanged. And finally, Amazon is expected to launch its first batch of 27 Project Kuiper satellites Wednesday as it seeks to compete with SpaceX's Starlink to provide broadband connectivity.
This FYI was sponsored by Interactive Brokers. Direct market access to stocks, options, futures, forex, bonds and ETFs. One world, one account.
For the 4th consecutive year, Interactive Brokers is one of the fastest growing prime brokers and is now number 5 in Preqin's ranking of top prime brokers. Interactive Brokers serves both organizations and individual investors. To get better results, get a better platform. The best informed investors choose Interactive Brokers.
The Power Plays are here, breaking down the markets with updates and deep dives. What's moving now and what's next for your money? Sarah Eisen, Carl Quintanilla, Money Movers, weekdays, CNBC.
Kelly Evans, The Exchange, CNBC.
And we were listening in earlier, moments ago, President Trump is speaking at the National Republican Congressional Committee dinner, and this latest line coming through, he's saying right now China is paying a 104% tariff. Remember, we were just doing the countdown. We've got a little over 4 hours until the midnight of course, kickoff for these country-specific tariffs, but he is, I don't know, preempting that. But remember that we were also talking to our U.S. colleague, Eamon Javers, at the top of the show, and he was pointing out that the paperwork that would be necessary, required for these tariffs to go through. We're talking about that extra 50% on China hasn't been done, hasn't been submitted, has not been done just yet. But we've got President Trump saying that it is. It has taken effect, and of course, this could be just part of the rhetoric that we are seeing in tariff tension between the U.S. and China, and we'll be watching the related developments as well. Marty?
Yeah, indeed. Eamon was pointing out that one of his White House sources was saying that that documentation, that executive order is imminent. Yeah. So I guess we'll be seeing that paperwork soon. Sherry, let's take a look at oil, if we could. It's still under a fair bit of pressure. There's the pricing. You've got front-month NYMEX at 57.50, down 3.5%. Brent, the global benchmark, we're at 62.82 right now. So oil dropped precipitously again overnight. SocGen, Societe Generale, recently cut its price target for oil, sees Brent at $60 a barrel. WTI, West Texas Intermediate, at $57 a barrel by the end of this year. But if a U.S. recession is factored in, well, that number could drop lower to the low 50s, although that is not their base case. We're also watching metals after the White House announced it's going to exclude steel, aluminum, copper, and gold from reciprocal tariffs. Let's take a look at gold. Spot prices right now, $29.70. So we're a significant way off of record highs hit not too long ago. 29.71 and change a troy ounce right now. And finally, take a look at base metals as well. There's the pricing there. All right. Let's get to Ben Hoff, Global Head of Commodity Strategy and also Research at SocGen. He joins me here live around the desk at the SGX. Ben, great to see you. You're just in from New York, I know. With the clock ticking to that midnight deadline for a total of 104% tariffs on China kicking in, what are you thinking, especially on the commodities, especially on the ag side?
First of all, thanks for having me, Martin. Lovely Pleasure. To be here. Look, I mean, this is really a massive hit potentially to demand. I think we're going to have to see for a variety of markets that aren't ags-based what actually ends up getting negotiated away versus what ends up being, from a tariff perspective, part of a reset of U.S. industrial policy. For ags, really, the impact is going to be most predominantly felt within the beans complex.
Soybeans?
Absolutely, yeah. Exactly. But really across the board, bean oil, bean meal, bean products, really, that's really where the pain point lies most likely.
Okay. Sherry, come on to this.
What about crude, Ben? And, people are talking about potential stimulus coming out of China, but you don't really expect a major support for crude demand boost in China. Why is that?
Yeah, so Sherry, that's actually a really good point. The issue really when it comes to Chinese demand and demand growth is that it's really moved significantly over the past couple of years from being transportation fuel demand to now being exclusively petrochemical demand. That's where demand growth sits, and that part of demand growth is really sufficiently linked to exports for us to think that stimulus is not going to be enough to save that. We're looking for this year at roughly 250,000 barrels of Chinese demand growth. That was prior to tariffs, obviously, but those are very clearly at risk with or without stimulus.
What about OPEC Plus a decision next month? Because they are set to add more barrels next month. Do you think they will go ahead and they can afford to go ahead with that?
Again, a very good question, that, Sherry. From our perspective, the news flow surrounding OPEC is a little bit of a storm in a teacup. I think it's worth bearing in mind the context here. OPEC announced, obviously, last week in maybe unfortuitous timing that they were bringing back 411,000 barrels of production as part of a rollback of the additional voluntary cuts starting in May. The market was anticipating roughly a third of that, 140,000 barrels. But truth be told here, from our perspective, this looks a lot more like OPEC restating officially the status quo, where you've already had Kazakhstan, the UAE, and Iraq, each producing in excess of 300,000 barrels of their target. So when it comes to this number, our view is that it's actually going to only be probably on the order of 200 to 300,000 incremental barrels that'll be hitting the market in May, rather than that very big headline number of 411,000.
Ben, I want to take it up to 30,000 feet, right? And neither side, the U.S. and China, are talking just yet. When and if they do get down to brass tacks, right, and start to cobble together maybe some sort of deal, right, how much would energy figure into this? I mean, obviously, the U.S. wants to sell more energy, whether it's crude or more probably LNG. Can you envision that being part of any sort of deal between the two sides?
I think, again, that's a really good point, Martin. I think very much when it comes to a potentially negotiated unwind of these tariffs, it's really the energy piece and specifically the LNG piece where the needle could be moved. Just bear in mind, China last year imported of its overall LNG imports only 2% from the US, and that is down very significantly. So there is definite room to move the needle on LNG imports from the U.S. as a potential concession.
And the geopolitical point would be to wean China off cheap Russian oil, obviously, yes?
Yes, that would obviously, that would very much be in focus as well, although probably much more of a somewhat related but separate topic, which is how does Russia-Ukraine get settled?
All right. Listen, Ben, wish we had more time. We don't, but thank you so much for dropping by. It's great to talk to you. Safe travels, and see you again very soon.
Lovely. Thank you, Martin.
Pleasure is ours. Ben Hoff there from StockGen joining us live. And stay tuned. We've got market opens just ahead. Tokyo, Seoul, and Sydney coming up right after this.
So we have been here for the last 90 years, and because of that, it's so important. We have a long-term brand building goal and journey. Short-term marketing effort, short-term KPI is critical because these are the building blocks. By validating a lot of the activities, through engaging our customers, through discussing with them their needs, understanding what we want to do, eventually we add them together. That is our long-term brand strategy. Banking is a people business, and that's why we need to enable and trust our team, our teammates to work, so that they know very clear strategic direction from the head office, from the seniors, and we lead by example.
Every new vehicle we put out, we're improving fuel economy and emissions.
We need a balanced and a fair energy transition for everyone.
The total value chain of battery will be very important.
Improve our operational efficiencies and reduce the consumption of natural resources.
Environmental sustainability is a must, and energy security is another pillar.
Renewable energy is cheaper than electricity made from fossil energy in 90% of the world already today.
Fostering sustainability on CNBC.
I think ambition is really an extension of faith. If you first off believe in yourself, that gives you the power to chase your dreams. My ambition starting out was to have a career, not a job. I wanted to be excited to go to work every day and go someplace where I could grow, learn, and engage. CNBC viewers are definitely ambitious, and I think most of them see their money as a tool, a way to pursue their dreams and pursue their goals. I hope to always be a clear, accurate, and investable voice for all of our viewers. You'll learn a lot here at CNBC. It's also a lot of fun.
Good morning, everybody. I'm Shara Kang in Hong Kong.
And good morning, folks. I'm Martin Sung in Singapore. These are your headlines this hour. We are on tariff countdown. Just 4 hours to go, less than that, in fact, before the U.S. President Donald Trump's reciprocal tariffs kick in. And China is going to be creaking under a total 104% levies ahead of that. You've got futures nervous. They are edging lower.
China's offshore yuan hitting all-time low, inching closer to the 750 handle. A weaker currency could help make Chinese exports more attractive to other countries as Beijing's trade war with Washington escalates.
Plus, South Korea rolling out emergency measures to help prop up the local auto industry hit by U.S. tariffs, raising financing support for car makers and lifting subsidies for buying EVs. Right to our top story today. In just the last couple of minutes, we had U.S. President Donald Trump saying that China is paying 104% tariffs right now, although it sounds as though he is anticipating what is actually about to happen just after the stroke of midnight Eastern time. Because there's still 4 hours to go, a bit less than that, before that deadline. That's when country-by-country duties kick in, and China, meantime, is staying defiant, saying it'll fight till the end, despite getting slapped with stiff tariffs. Again, the number that we are working with right now is just a second after midnight. Tariffs go up to a total of 104% on imports from China. Ahead of that, this is how futures are pricing. They are handicapping what looks like a more give back or downside when Wall Street gets back up and running tonight, Asia time, after just another wild session overnight. The market was up as much as 4%, then Turntail gave it all up and more. Sherry?
Yeah, and we've got markets in Japan and South Korea, as well as Australia, of course, just coming online. And we've got pretty much right across the board. Quite interesting how the Kospi is looking very resilient, staying very close to the break-even point. Perhaps it's really the phone call, the very first one, by the way, between President Trump and a leader in South Korea since he took his office. And we are looking at, Nikkei 225 giving up a 1.7%, ASX 200 also down close to 1% as we speak. And really zero in on a winner, if you can call it that, the Kospi. Of course, the phone call is interesting, given that we learned some things in terms of how the White House is putting priorities on some of its ally countries. That is coming from the White House economic advisor. So that is one thing. And let's perhaps zoom in on South Korean automakers. After the government, of course, announced extra support measures, they actually upped the amount as well to 15 trillion Korean won. Although we don't really see a lot of positivity playing out here, the government is definitely watching this particular sector, as it's believed to be one of the hardest hit sectors. And then we're checking in on the defense names as well as the shipbuilders. I point them out because they are the major Trump trades. This is a sector that we've been seeing as sort of standout winners in South Korea since his inauguration day. In fact, his election days as well. But we don't really see a lot of upside coming through for the defense names. Perhaps shipbuilders are doing better. There we go, because the market believes that this is an area where South Korea can actually offer help to the United States when it comes to the commercial side as well as the Navy side. So I think that's the market's thinking, sending these shares higher at the moment. Marty?
All right, Sherry, it's probably a good time to take a look at what's going on with the currencies as well. And, of course, the big focus is on the Chinese currency, the renminbi, because the H's offshore, if we can bring up that chart, are at a record low right now with less than 4 hours to go before those U.S. tariffs on China of 104% kick in. And we're watching the Chinese currency because potentially it could be one way for China to absorb the impact of those tariffs by using the currency as a buffer. And what we've seen in the last couple of sessions is in the daily fixes at 9:15 Hong Kong, Singapore time sharp on weekdays, the midpoint for the currency, China has managed it or fixed it incrementally lower with each day. So it's baby steps, but the big risk or worry is, are we going to see, as we did in Trump's first term when he slapped tariffs on China, a big one-off devaluation in the renminbi? Excuse me. So right now, H's, we're at practically 740. Folks are calling 750. Some people are worried about even this cross hitting an 8 handle here. So I don't know. Baby steps right now, Sherry, but the way it's going, I think a lot of people are worried.
Yeah, and baby step, I think that is the perfect way to describe it, because many are saying that if that is the intention for Beijing, for the PBOC, that you will actually do it in a gradual manner. And we've got President Trump pushing for that 104% tariff on China and really preempting that by a couple of hours as well. And does it, I don't know, bolster Beijing even more to weaponize its own currency? And let's not forget about other currencies that are reeling as well. I mean, I have to point out, the Korean won at 1486. So that is the weakest since, I believe, so the dollar is highest versus the Korean won since December. So, and, when we're talking about, currencies like the Korean won, and many are too, because of their heavy trading relationship with China, they tend to actually go with the Chinese yuan. So what is the implication for that? And this is not really the point where we talk about weaker currencies that tend to benefit exporters for these countries as well. Marty?
Yeah, where the renminbi goes, a lot of other currencies follow. It's almost inevitable. Meantime, though, positionally, China is defiant, digging in its heels, right, saying it'll fight to the end. So, nope, it's not talking. I tell you who are talking, though. We've got a team of senior Japanese officials kicking off trade talks with the Trump administration in D.C., and CNBC's Kaori Anjoji is following those negotiations from the Japanese capital, Tokyo. Good morning.
Good morning, Martin. Well, we should start talking about the real economic impact on Japan, because the Japanese economy is in a very precarious state. Economists I speak to say that the range on the impact on GDP could be minus 0.3 to minus 0.8% is the highest estimate. And the Japanese economy really can't afford that at this point, because in the first quarter, you had consumption probably under pressure because of price pressures, especially at the supermarket. So we have, negotiators in Washington talking to the Treasury Secretary. But ahead of those talks, here's what the U.S. Treasury Secretary had to say.
Look, the Japanese are military partners, they're economic partners. We have a substantial imbalance with them, and I'm sure that they are as anxious as we are to get this remedied.
Well, looking at everything that is on the table, the USTR, of course, will be leading negotiations on that front as well. We got a hint of that from their representative overnight as well. Agricultural products and industrial products. Guys?
Kaori and Joji there, thank you so much for that report. And let's take a look at how stocks in Tokyo are doing with the tariff drama. Well, actually, before that, let's go back to Kaori in all this. And I actually wanted to ask you this for the last couple of days, Kaori. And when it comes to Japan's situation, there's also the domestic politics that we need to think about, given that Prime Minister Ishiba is not running on such strong popularity at the moment. What would be the implication going forward for the Japanese leadership if these tariffs end up hitting Japan so hard?
It's an interesting question, but I think right now Japan wants to make this a united front, and it's a full court press. And I think the opposition is edging towards a place where they say, look, we need some better leadership than Ishiba. But remember, he's one of the first guys that got on the phone with Donald Trump, and he wants some FaceTime. That possibly could happen. So I think maybe right now is not the time. But you also have to remember that this is an election year. There will be an election coming up in the summer. If there's a no confidence motion passed against him, we could see a dual election as well. So he came in as a very weak candidate. But I think at the present time, I don't think anyone, including the big companies in Japan, and by that I mean Toyota and everyone that's linked to that company, want a change of leadership right now. Sherry?
What is the narrative around BOJ playing out in the markets at the moment? Because in the case of South Korea, for example, Kaori, we've got the Bank of Korea may get a little bit more dovish. That is the market speculation at this point in time, although they don't want to be fanning inflation down the road. But I would imagine it's a different kind of a rate action for Japan, potentially?
It's a tricky situation that the Bank of Japan is in right now. I mean, it was tricky to begin with. So let's dial back to pre-tariffs, okay? This was another world, and it looked like the Bank of Japan was ready to normalize, and by that I mean raise interest rates, particularly because the food inflation was hitting the consumer hard and was hitting consumption, and finally it looked like this 2% target that the central bank had been talking about all along was within reach, and wage growth, at least for this fiscal year, seemed to be on a par with that. But this whole Trump situation and the tariff situation throws that into doubt, because you are looking at a possibility, a real possibility, that Japan will be brought down, dragged down with a global recession. So that makes it very tricky. The one point I think I don't want to say easy, but for the equation for Bank of Japan is the yen. And Donald Trump and others have been saying that using the currency to make exports, Japanese exports, more competitive is a strategy that they want changed. So by that, you would mean that they want to look at the yen strengthening. Now, look, the Bank of Japan was a hard-won independence, so I think it's going to be very difficult for them to say that that is the reason for them to do what they are, that possibly what they do. But this puts them into a very, very difficult situation, because not only do they have to think about monetary policy, they have to look at fiscal policy and the political pressures, which are enormous right now.
Kaori, thank you so much. And of course, it's always great to have you on. And, let's actually keep that FX board up there and broaden out for the Asian crosses, because I do want to make a correction for the Korean won. I mentioned it is the weakest level versus the U.S. dollar since December at the top of the show. It is actually the weakest since March of 2009. Versus the U.S. dollar, and I would imagine that makes much more sense here. So we've got the Korean won at 14.86 per dollar, and the Japanese yen at 145.65. And let's take a look at how stocks in Tokyo are doing with the tariff drama. Lin has the market action. Lin, Nikkei 225 giving back some of yesterday's gains. A similar dynamic playing out on Wall Street as well as other regional peers as well.
Yes, good morning to you, Sherry. Indeed, so unable to hold on to some of that recovery yesterday, given what we saw overnight, the fact that the White House is pushing ahead with those 104% tariffs on China. That certainly weighs on the sentiment, given that these are the two largest economies in the world, and overshadowing hopes by the market here that there could be some sort of a trade deal negotiated between between the US and Japan. We're hearing that rhetoric, although we're talking about very, very early days now. In the FX space as well, we've seen a renewed sort of piling into the Japanese currency overnight. That will add an additional headwind for Japanese equities, particularly exporters today. And, you know, interesting because we were just hearing from Kaori talking about the Bank of Japan. We do have the Governor Ueda making some comments this morning and basically reiterating that, you know, they are watching and analysing the impact that these US tariffs will have on Japan's economy, and emphasising that there is still heightened uncertainty here remaining on how the policy is going to impact prices and the Japanese economy. But certainly, as Kaori was highlighting there, some conflicting sort of points to negotiate, whether we're talking about the yen or the underlying weakness in the Japanese economy as well. Martin.
All right, Lynn, thank you, Lynn, there. Still ahead, our next guest says he's focused on earnings and attractive valuations, but how do the tariff tensions play into his strategy? Sid Jane from GQG Partners joins us right after this.
Singapore is deeply invested in the growth of Asia. We believe that Singapore will do well when our region does well.
The debt issue. We have a very severe supply-demand problem. That's a big deal.
And if you can't put the what and the how in a consistent, clear, and meaningful way, then you could end up with high levels of volatility and conflict.
No American voter will ever accuse Donald Trump of being weak on China.
The largest government, the largest economy, the biggest capital market in the world is now holding Bitcoin.
Sponsored by
The Philippines has been stuck in an infrastructure deficit for a number of decades. Should it not be attended to, it will continue to be our really number one roadblock to sustaining our economic growth. We focus our attention on power, gas, waste management, and water. For each one of those sectors, we try to address a fundamental need. When water is reliable, we have dependable energy, we treat our waste the way it should be treated. Certainly, we create an ecosystem that's more conducive to foreign direct investments and economic growth. Sustainability and growth for us are one. We get things done, we are relentless, we deliver that critical infrastructure. The challenges are significant, but we've created a team that's extremely talented, absolutely equipped to execute.
The day's top stories driving Wall Street. Up-to-the-minute developments. Kelly Evans, Brian Sullivan, Power Lunch, CNBC.
The Bond Report is brought to you by PIMCO.
Welcome back. Midweek Wednesday here on Squawk Box Asia. You've probably seen the wild rise on Wall Street yet again overnight. Stocks were up sharply, then gave it all back, and then more. But here's the interesting part, right? Yields. This is how they're pricing. The 10, we are back up at 434 for all intents and purposes, edging even higher than I checked last hour. The short end 2 is at 371.32. So in other words, even with the massive drawdown we've had in stocks, the 10-year yield is back where it was. Actually, it's a little bit higher than it was before what President Trump calls Liberation Day. So go figure. CNBC's Rick Santelli has the latest in the full bond market report. Take a look.
Good morning, Asia, Australia, New Zealand. Well, tomorrow we start to get some economic data, wholesale inventories and trade, and then later in the afternoon we'll have the minutes to the last Fed meeting. The big data points, of course, are going to start on Thursday. And on Thursday, we're going to have CPI, and on Friday, we're going to have PPI. Those are the biggies of the week. As far as today, well, what we did have was the first of 3 auctions. We had a 3-year note auction, $58 billion, and it did not go well. Very weak demand, it tailed, and it turned the market. After 1 o'clock Eastern results, interest rates went from slightly lower on the day to higher on the day, and it was led by long maturities, and the curve steepened to over 50 basis points for the first time in 3 years. Actually, February of 22, a little over 3 years. If you looked at the equity markets, they were super strong early in the day, and as the notion of tariffs in China became the talking points of the day, it started to lose ground. It did manage to get some green back, but nowhere near the amount of green, especially in the Dow, that it had earlier in the session. When you do look at interest rates, not only did the curve steepen, but what we really want to talk about is how long rates have gotten so much more buoyant. And remember, as we focus on tariffs and try to divine if it's a one-time inflationary shock, if it happens at all, or is it more of a lingering effect? Well, we really don't know that outcome. But when you have debt and deficits the way we do, a weak 3-year note auction and 10s and 30s to follow, it certainly seems as though the longer maturities are much more alive to the upside than they have been. And I think we want to pay very close attention to not only did we hold 4% on a closing basis this week, but we are now at that 4.25 level. And should we start to close above that after having exactly a 4% low yield close on this move, that would go a long way on the technical side to bring in more selling. Reporting from the CME HQ, I'm Rick Santelli, CNBC Business News, Chicago.
The Bond Report is brought to you by PIMCO.
We're predicting good growth for tourism, so an increase by 6% in value to about £33.7 billion inbound spend this year. But the overriding challenge we have is that more than half of our visitors won't go outside London, but we want people to explore more of the country. We have launched our Star in Great Britain. That's a film and TV campaign. We use those stories that connect with people, the destinations that they see in their homes and they want to come and visit. And all around the country, we have different stories that we can tell that will encourage people to go out of London and explore more.
Ambition to me is the drive to succeed, to improve myself, and hopefully in doing so bring some good into the world. I wanted to be a trusted source on all things tech. I realized there was opportunities to tell stories across multiple platforms, so I learned, adapted, and created new roles.
Can't miss reporting that impacts your money now. Be here when the opening bell rings. Squawk on the Street, CNBC.
Welcome back to the program. Here is another look at U.S. futures, and we do see some negative Q coming through. And in fact, just over the last half an hour or so, showing even more, greater level of negativity. NASDAQ now implied down by 350 points as we speak. Sid Jain is a deputy portfolio manager at GQG Partners with over $160 billion U.S. dollars in assets under management as of February. Sid, even the dead cat bounce that we thought we were seeing overnight, even that failed. It's scary out there. Did you buy anything over the last 4 days, or are you waiting it out? Where are you seeing alpha generation in this market route?
First of all, thanks for having me on your show, guys. Pleasure to be here. Taking a step back, for the past few weeks heading into Liberation Day, our view was take President Trump seriously when he makes these threats. And so we have been very defensively positioned and continue to be even more so now in boring sectors, so to speak, that have defendable earnings growth with strong dividend yields, places like insurance, healthcare, utilities, telecom. I would say more broadly, other than that, we're actually becoming pretty negative on the technology sector as well. where we believe these areas, the Mag 7, are far more capital intensive and cyclical than people give it credit for. So we continue to be cautious. The last thing I'll say is our concern with tariffs and the political noise has less to do with the earnings trajectory, even though there will be implications, but it also has to do with the valuations for broader equities, particularly in the U.S. You're coming off the 15-year bull run, massive fiscal stimulus of the past few years. S&P 500 during the last trade war in 2018 troughed at 14 times earnings. So there could still be material multiple compression from here, which is our big concern.
Do you have a level in mind in terms of valuation for S&P 500? Because you're basically saying that there is more to go to the downside.
Yeah, so if you take a longer term view, generally speaking, S&P 500 trades at, call it 16 times earnings over a very long period. But in recessions or when there is increased political uncertainty, fears around a recession or economic slowdown, the market can go much lower. Now, I'm not saying we'll get there overnight, but the problem is most equities, particularly the favorites, the winners of the last decade, generally trade at elevated multiples. And so that remains our big concern. Less of an issue once you leave the U.S., which is why we're actually a lot more positive on some of the international countries out there. But the U.S. has enjoyed massive multiple expansion as well as margin expansion, both of which are now at risk.
And you see EMs as a great portfolio diversifier. Which particular EMs do you like? And given all the tariffs environment, do you need to get really selective here?
You're absolutely right. There's people group emerging markets as one asset class, but there's a really wide spectrum in terms of the types of countries and their exposure. So we continue to be very bullish on India. We've been that way for many years now, and so it's not due to tariffs. We like the longer-term earnings trajectory, but now they're also the emerging market that will be one least impacted amongst the majors with tariffs, because unlike China, Korea, Taiwan, India has always been a consumption-driven economy, never depended on exports to the same extent some of the other Asian countries did. So we continue to be positive on India. Other countries would be Indonesia, Brazil, and pockets of the Middle East as well, where we're finding opportunities.
All right, and quite interesting because we've got to President Trump saying that he thinks that China will make a deal at some point. We would like to ask him, when is that happening? But Sid is sticking around for more conversation with us. We'll come back to Sid Jane in just a few minutes. Squawk Box Asia is going for a quick break. We'll be right back.
Today's Most Active Stocks Update is sponsored by Interactive Brokers. 150 markets, 33 countries, 27 currencies. Today's Most Active Stocks Update was sponsored by Interactive Brokers. Trade worldwide from a single unified platform.
Good money.
Everything seemed legit until it wasn't.
Good times.
the lavish lifestyle, the houses that they're used to.
Fame, fortune, and fraud.
His stories were so good, they all fell for them.
American Greed on CNBC.
We're moving from the autopilot era of AI to co-pilot era of AI.
We are just at the dawn of the robotics age.
The more experience you give it, the more capability this AI model can achieve.
Hopefully improves productivity, and it doesn't displace more jobs than it creates.
How to maintain our humanity if we live more and more digital lives.
The new era of tech on CNBC.
I took my first journalism class in high school. It felt like a superpower. I find it really meaningful to reach new audiences, women, people of color, younger demographics. A lot of traditional financial advice might not take into consideration that people have debt or that rent is so expensive. To me, ambition means taking on new opportunities that take you out of your comfort zone, but help you learn and grow.
Quick check on markets currently trading in Asia, shaping up like this. Negative pretty much across the board. We've gotten a lot of pain coming through for Nikkei 225, giving up a 3.7%. And we are waiting for, of course, the Taiwan markets to come online at the top of the next hour. Taiwan investors had already suffered from 2 days of big losses. Emily Tan is joining us. I would imagine, given the U-turn that we saw on Wall Street, more of selling, I guess, on deck.
Yeah, there's a bit of nervousness that still persists in the market. We did have extended losses coming through from the Taiwan market after what was the biggest loss in history in a single session, where the market closed down about 10%. That extended into yesterday's close. It was down 4%, a pullback of about 770 points. Some investors buying into this dip. We saw turnover come back, $16.6 billion compared to the $4 billion on Monday when we had that huge wipeout in the market. Keeping track of some of the heavyweight stocks, TSMC continued to sag, but down 3.8%. Hanhai Precision closed the limit down now for a second day running. We did see the government support coming in, the National Stabilization Fund, $15 billion coming in to support the market, saying that they are ready to support the market as and when needed. This would be the 9th intervention since the Stabilization Fund was created back in 2000. They have come in a number of times. Most recently in 2022, they intervened twice into the market, $1.6 billion across something like 275 days. But the biggest intervention was back in 2000 during the dot-com bubble, and that was an intervention of $3.6 billion into the market. So they say that they're going to be carrying out stabilization as appropriate to maintain the stability of the stock market. Yesterday, there was a lot of downside, but in the financials, we saw a little bit of strength, a couple of spots of green coming through from the likes of Mega as well as Huanan Financial. Mega shares up 7.5%.
And the short selling ban, so it's across the board. It's for this week alone. But is there any sign that maybe they will extend this? I mean, obviously, the market hasn't recovered just yet. If anything, we're watching these negotiations. If we don't have any tangible deliverables from these dialogue, then we could actually see more negativity, or at least a lot of uncertainty still out there. Is there any indication of that from the Taiwanese authorities at this point?
I think they're still watching because we are at Wednesday today. There is more weakness in store for the market. Futures are pointed down 0.4%. So it's a short selling curb, not a ban. So they've lowered the amount in which the shares can be shorted to 3% from 30% of average daily turnover for a stock. And of course, it's in place for all of this week. And whether or not it's going to be extended, there is no mention of that just yet.
And really quickly, I was just watching Korea K-drama stocks this morning, just out of curiosity, just because some of these influencers in Beijing, in China, they were saying that China's next response to all these tariffs, it could be blocking Hollywood movies. maybe this is something that you need to, I don't know, bring up with some of the guests on your show as well.
Well, maybe there's no interest in watching U.S. films to begin with. Right now, the top 5 movies in the box office are not foreign films. They are local names. Of course, Ne Zha is very, very popular. That has been a huge global hit. But in terms of some of the things that these bloggers are talking about, film import restrictions, banning imports of U.S. poultry, increasing tariffs on agri-products like soybean as well as sorghum, the Commerce Ministry has said that they're going to be taking steps to safeguard their own interests. So this is just what's being, talked about in social media. Nothing official just yet, but of course, movies. We'll see if that's one of them.
I don't know. Cultural decoupling, I would imagine. Emily, thank you so much for that. And Marty, it's back to you.
Yeah, thanks, Sherry. And, we were talking to our colleague Eamon Javers up over in D.C. Earlier this morning, and he was saying the paperwork had not been submitted yet for the 104% tariffs, or the extra 50, in other words, right? But that he was told by a source in the White House that the paperwork is imminent. Well, now we have reliable information telling us that, yes, that paperwork is in. The documentation is in. So there you go. We're looking at it right now. So, this says it is happening just after the stroke of midnight to Eastern time, which is 12 noon out here in Asia, Hong Kong, Singapore time. And on President Trump, I've got some lines out from him. He was just speaking at the NRCC dinner. And just to recap, he is kind of front-running that midnight deadline, saying that China is paying 104% tariff right now. It could be yet another one of these fudges that we've come to expect from him. But he says the key line, I think, from this is, he says China will make a deal at some point. Plus, he says we're going to tariff pharmaceuticals. And this is important because it had not been, at least initially, on the table there. And he also says that China is manipulating its currency to try and offset the incoming tariffs from the U.S. And obviously, this is something that we've been watching very closely as well. There's President Trump still speaking live at the NRCC dinner. We'll follow along and listen along to see what he has to say. But again, back to the issue of the currency, we're going to be watching 9:15 sharp Hong Kong, Singapore time when China fixes the midpoint of its currency, the renminbi, to see just how much weaker it allows it to go. The number you're looking at right now, H is offshore, 740.17. That is a record low for the renminbi. In the last 2-3 sessions or so, the setting in the midpoint had been gradually ever lower in baby steps. But again, the big risk that we've been talking about is whether or not China resorts to a big one-off devaluation of the renminbi, such as what it did back in Trump's first term in reaction to Trump slapping tariffs on China. So the currency is something we're continuing to watch there. All right, meantime, let's bring back Sid James, still with us live at GQG Partners. Sid, I want to get on something that we were talking about offline earlier this morning, and that is back to the U.S. Why, given the drawdown, the massive drawdown we've seen in equities, right? Why is the 10-year back up where it was? In fact, it's even higher. Spring of the charts, we're past 430 again, and this is even higher than it was before what the president calls Liberation Day, when all those tariffs kicked in. What gives?
Yeah, so there are a bunch of different variables to this, and I'll be the first to caveat that we're an equity-focused shop, so might defer to some of my bond-focused colleagues on that. But look, it could be a function of folks selling what they have and the most liquid assets, which tends to be treasuries in this sort of panic mode. There are other rumors that maybe China is finally starting to offload its treasuries in a much bigger way. I think what's more concerning for us is just the volatility. It makes it incredibly difficult for businesses to operate and take a longer-term view when you're seeing these types of fluctuations on a day-to-day basis with the interest rate markets. And so that's what we're really focused on when it comes to the equity side, which is what we are focused on.
Yeah, we're showing folks the VIX right now, the volatility index, right? 52.33. I guess that's better than 60 because we were north of 60 about 24 hours ago. What is that telling you right now?
Look, there's clearly a massive amount of uncertainty in terms of what happens in the White House. Is a trade deal struck? When is it happening? And the problem is that even if a trade deal is achieved tomorrow, which is highly unlikely in our opinion, the uncertainty won't fully go away because you will never know for sure, will there be new tariffs a week from now? And so again, if you're a business operator thinking about putting a multi-billion-dollar investment on the ground, that takes a multi-year view, which is very difficult to do in this type of environment when the policies are changing on a minute-by-minute basis sometimes.
Yeah, and, coming up on Friday, we've got the big financials kicking off the new season of earnings, right? And I'm wondering whether or not, all the numbers that we're going to get are kind of moot. I mean, they always are, right? They're rearview mirror. It's historical. And what the main focus is going to be is on the guidance, right? And to your point, in a situation like this, nobody can commit to CapEx, to planning, to basically, or hiring or anything, right?
You're absolutely right, because from our view, the first leg of this bear market thus far has been driven by multiple compression. But we haven't seen the next leg yet in terms of earnings starting to get cut. And that is our big concern, because anecdotally, when you talk to companies offline, when you talk to suppliers, there's a significant amount of fear in the markets. And in terms of how will they have to slow down on headcount? Will they slow down on CapEx? And we'll start to get some signs of that this upcoming earnings seasons. But it won't go away. This is not a 1 month issue. This is a longer term concern. If you're Apple, as an example, I mean, how do you shift your supply chain anytime in the near future?
Sid, big question for you. I think you'd probably agree that, the trade war has only just begun, right? There's probably more to go. And I want to know, the folks looking at the market and going, if that's the case, then it looks like there's more to go downside for the market as well. And they're looking at a number of maybe an 18 PE with the EPS at $200 a share before we get any sort of real clearing. Is that, are those numbers that sound realistic to you, or do you think it's even worse?
Look, it's tough to put concrete numbers on this, but if you just look back historically, the multiples can compress far more than people anticipate, especially since we're coming off such an elevated base. I mean, it's been a 15-year run now in U.S. equities, and margins are at record highs, and you're now only starting to see that come off. And so, yes, look, if these tariffs stick the way they are, the downside could be material. We believe the U.S. is probably more at risk just given the valuation starting point, but it'll impact and ripple into most other countries in the world as well.
All right. Sid, listen, got to go. It's been great to talk. Appreciate the time. Buckle up, keep safe, and do it again very soon, I hope. Sid Jain there from GQG Partners joining us live. Pleasure. We'll take a quick break. We're back in 2.
Leaders from the world of sport talk tech.
You have technology that is now allowing coaches to reduce the risk of injury.
And new growth opportunities.
There's an opportunity for players to play across different platforms. I think that's really wonderful.
People like to lean forward and engage. Only on CNBC.
Sponsored by
At Interactive Brokers, independent RIAs work with the best research and trading tools designed to help them outperform the markets. Meet them at Interactive Brokers Investors Marketplace for advisors. Advisors at Interactive Brokers keep all they earn on our low-cost platform, with no ticket fees or custody charges, low margin rates, and high interest earned on idle cash. To get better results, get a better platform. The best informed investors choose Interactive Brokers.
Tiny homes.
Welcome to my tiny house in Atlanta, Georgia.
One woman makes big money with a very little house.
Pretty spacious, honestly.
Plus the Big Apple's version of living little.
My 95 square foot New York City apartment.
And downsizing to unlock a better life by the beach.
No regrets about moving into a tiny house. There's no room for excess or unnecessary objects.
That's all next on Unlocked.
Senator, the president has been clear with me and with others that he does not intend to have exclusions and exemptions, especially given the nature of the action. If you have Swiss cheese in the action, it can undermine the overall point, which is to get rid of the deficit, achieve reciprocity.
That was a U.S. Trade Representative, Jamieson Greer, Trump's top trade negotiator, of course, coming under fire on Capitol Hill from senators concerned about the impact of the tariffs on global economy. At that same time, at the Senate Committee hearing, Greer telling lawmakers that not all of the USTR's proposed fees for Chinese-built ships to dock at U.S. ports will be implemented, adding that they may not be cumulative. The USTR saying the proposals were made to address a lack of shipbuilding in the United States. Let's dig a little deeper into the implications with Parash Jain, Global Head of Transport and Logistics at HSBC Global Research. Parash, thank you so much for joining us today. Let's kick off the conversation with shipbuilding. This is an area where President Trump talked a lot about as an example of cooperation that he can have with countries like South Korea. Just give us the layout of where U.S. shipbuilding stands versus their Chinese competition.
Yeah, thanks, Sherry. And as you were mentioning earlier, if you look at the current landscape and take 2024 as an example, 71% of global shipbuilding orders were placed at the Chinese yards, followed by Korea and Japan. And put together, they are close to 95% of global shipbuilding capacity, with a handful of them are produced in Europe and India. So U.S., to that extent, is a non-starter. For example, last year, China produces about 1,500 container vessels, and U.S. did 5. So with this backdrop, I mean, USTR, I mean, as you said, the original proposals was draconian to the extent that for each port call, if you're a Chinese operator carrying a Chinese-built vessels, you end up paying over $3.5 million. And that for a transatlantic route means that your effective charges would be more than 100% of your revenue. But where we stand today, world doesn't have much choice. I mean, how will you replace 70% of the shipbuilding capacity overnight? So our view is that... Sorry, yeah, go ahead.
Sorry to cut you off. So basically, this is the level of volume that we're talking about that South Koreans and Japanese cannot fill at this point, and it's just a non-starter for, I don't know, the idea of some sort of decoupling between the U.S. and China.
At this stage, for sure. I mean, if you see how the industry has reacted after the announcement of USTR, still more than 50% of the vessel orders has still gone to China. And that tells you that even the shipping industry, despite knowing this reality, probably see China as probably one of the very, very credible alternative at this juncture. Although we started to see some price divergence where the Japanese shipbuilds are now slightly more expensive than the Chinese. But beyond that, it's here to stay for foreseeable future.
Parash, I have to ask you a question. $3.5 million per ship, right? And there are thousands of ships that come in, right? That is going to raise a heck of a lot of money, potentially, right? You would think that the end goal would be for at least some of this money to be directed towards trying to up or increase or bring back U.S. shipbuilding capacity. Is that the actual intention, do you think? Or is this even if it is, isn't this sort of a very roundabout way of doing it?
And as you rightly pointed out, even if you start it today, it will take a couple of years before the first ship can be built, right? I mean, if you talk to some of the industry leaders, they say that on a like-for-like, a vessel built in US probably costs you 5 times more, and it takes about 3 times longer versus a ship built in Korea or Japan. So to that extent, it's a non-starter. And what you would see in a very near term, assuming the USTR goes through as proposed, you will see a chaos of epic proportion, because the shipping lines will start to drop the port calls in a second-tier ports in the U.S. They'll try to divert their cargo to Canadian and Mexican ports. You will see a congestion building up into the port. It probably will be a COVID 2.0. And that's why overnight you heard through Reuters that there are talks going on that it will not be implemented as it is. They are probably trying to avoid the cumulative taxes. So it will be in a watered-down version, but probably it's more of a tactics of a larger trade negotiation, I would say.
Okay. Sherry.
What's your forecast in terms of a potential pickup in demand for shipping within the Asian region or Asia along with other regions United States, given the tariff environment? Because we did just hear from South Korea's acting president, Han Duck-soo, saying that we're not going to, gang up on the U.S. With retaliation with countries like China and Japan. But I wonder if this would, lead to more busier trading between other countries, again, ex-United States.
Yeah, there will be a collateral damage. So yes, probably the import into the U.S. will hit the hardest. But if this tariff stays, we'll not rule out probably global trade declining in this year. And this year can be a year of two halves or 4 quarters where we have seen a strong import growth into the U.S. in the first quarter. Probably will lead to a pause or rather a decline into the trade into U.S. and that will have a ripple effect across because a lot of the trade between China, Vietnam, China, Thailand are with semi-finished goods which are ultimately intended to be end in Europe or U.S. So yes, Asia will be relatively immune, but it will still face the brunt.
Gotcha. All right, Parsh, great to talk. Thanks for dropping by. Loved it. Take care and come back to see us again very soon. Parsh Jain, HSBC, joining us live. A lot more ahead on Squawk this Wednesday. Stay tuned. We're back in 2.
Today's Forex Update is sponsored by Interactive Brokers. 150 markets, 33 countries, 27 currencies. Today's Forex Update was sponsored by Interactive Brokers. Trade worldwide from a single unified platform.
Scott Wapner from the NYSE. Closing Bell, CNBC.
Journalism was always the perfect career for me. There's nothing better than breaking news, jumping on camera and telling everyone immediately what they need to know. Ambition definitely fuels the tech industry. There's still this air of possibility when a new tech product comes out. I couldn't imagine doing anything else.
You're French, the son of 2 physicians, grew up in a family where you're focused on medicine and life sciences. How would you describe your leadership and your management style?
I'm very collaborative. I don't like consensus, which was something we changed.
You don't like
company.
Consensus?
No, because I think that consensus is slow first, but also sometimes impossible to reach when you have a tough decision to make. So often everybody agrees, but if there is no consensus, it's not a reason for not making a decision. So very collaborative. I try to have a lot of proximity with people. I am very approachable. I want to be very inclusive. I empower a lot the Takeda executive team. So again, I think creating a culture of performance, but respect and inclusion and collaborative.
Welcome back. It's a Midweek Wednesday here on Squawk Asia. As the clock ticks down to midnight, remember, a second past that is when reciprocal tariffs kick in the United States because it is going to be April the 9th there. Countries are still scrambling to negotiate with Washington. Vietnam is one of them. And JP Young is one of the countries where, the talk is they're both trying to get to zero tariffs.
Absolutely. But it's going to be very, very difficult in Vietnam's case because we know they have one of the biggest trade surplus with the United States to the tune of about $123.5 billion US actually. And if you take a look at this also, Martin, you'll notice that that this is also why Vietnam has one of the biggest tariffs, 46% actually on them. So General Secretary To Lam has been on the phone with President Donald Trump, which the American president has characterized as being productive talks towards getting to these zero tariffs, or perhaps to trying to improve the trade surplus that Vietnam has with the U.S. They have extended an invitation to open talks, and even extended an invitation for President Donald Trump to visit Vietnam in order to kickstart some of these talks. And Mr. Trump has actually said he has accepted the invitation. The question is, when might he visit and when can these talks actually happen? Because the clock is indeed ticking. These tariffs are set to come online very soon. Now, Vietnam itself has stuck by their 8% growth, GDP growth target, actually. But again, if these tariffs do come in, it'll make it much more difficult for them to actually hit that, and could actually even imperil one of Southeast Asia's fastest growing economies, actually.
So the give and take, right? Who's likely to give what?
I think one area actually that was very interesting to note was Vietnam has now signaled that they are now open to buying more defense products from the United States. Now, if you recall, back in the 60s, they had this little tussle actually that resulted in a protracted war that really marked or shaped both countries and the history of both countries. Now, Vietnam seems to be looking at the United States and actually is now open to buying more arms, perhaps defense products, security products from them, especially since an arms embargo was lifted on Vietnam, or the sale of arms, an embargo on the sale of arms to Vietnam was lifted back in 2016. Now, what's interesting also is that when you look at the source of arms to Vietnam, there are three major exporters of arms to Vietnam. That happens to be Russia, Ukraine, and Israel. Guess what these three countries have in common? They are all embroiled in conflicts at the moment, and we've also seen that based on recent data, the exports of Russian arms to Vietnam have actually trickled to about zero over the last 2 years. So there is a severe need actually for Vietnam to upgrade their military and perhaps also increase their sources, actually, which means the United States can step in. But given the history of these two countries, especially that they did engage in that bloody war about 60 years ago, it's a very interesting turn of events, actually, and creates new opportunities for them. But again, will that fill $123 billion?
Well, yeah, I mean, there's been a generational change since the Vietnam War, right? But you make an interesting point, right? The arms being supplied by all three of those countries, Russia, Ukraine, as well as Israel, are battle-proven, right? Mm-hmm. And they're probably cost-effective as well, would be a way to put it. U.S. arms are likely to be, more expensive, and it's not so easy to switch systems, right? When you're used to, let's say, a Russian AK, it's not as easy to switch over to something made in the U.S.
Absolutely.
I mean, in fact, parts, servicing, all kinds of things to think about.
Exactly. And in fact, this is something that a defense analyst I spoke to many years ago actually raised when President Rodrigo Duterte of the Philippines was entertaining buying Russian arms. He said, look, just because you're going to switch from an AK-47 to an M16 in Vietnam's case doesn't mean it's as simple as waking up one day and saying, hey, you have a new rifle. This is a longer rifle. You'll probably need to train with it. You'll probably have to re-augment your tactics, at least, and your military strategy just a little bit to accommodate these new weapon systems. So it's not like for like. So there's a few things they'll have to consider, actually, if they want to do this.
Okay. All right. Great stuff. Thank you, JP. JP Ong there. All right. You're going to want to stay tuned for the rest of the market opens still coming up. That's happening next hour here on Squawk Box Asia. We're back in 2.
Lately, it's as though everything's upside down. Not here, though. Here, you'll find a safe space for ambitious risk-taking and radical innovation. And we're all so predictable, so you can confidently venture into the unknown. Because you'll need our trust, stability, and safety to make your next bold move. Your business needs Singapore.
Breaking news, market moves. Scott Wapner from the NYSE. Closing bell, CNBC.
You want people to trust their money.
This is the market that we're operating in. They need to drive their plans forward.
We need to pursue new business opportunities.
You're always better off having a fortress balance sheet.
Prudent fiscal policy can contain debt.
You're going to take less risk to get to your target now more than ever before.
Making sense of the global economy. CNBC.
For me, ambition and passion go together. One fuels the other. You love something, you want to get better at it. You want to learn more about it. And I think CNBC allows our viewers to fulfill their passions. There's no doubt that the people who watch us care. I am very much focused on trying to land interviews where there is something at stake and asking them fair but tough questions in which their answers are important. I could not imagine covering anything else